You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way with me, Sam Ball. Joining me today is our special guest, Connor from, is it pronounced Acacia or Acasio?
I pronounce it Acasio.
Well, you created it, so that's probably how it should be pronounced then. Yeah, so joining me today is our special guest, Connor at Acasio Capital, where he's the founder and the lead analyst. So if you're not familiar with Connor's name, you'll probably be more familiar with his Twitter handle, which is at Investment Talk with 2 Ks at the end. So Connor started investing in 2018 and has had returns since then of 118% versus 41% for the S&P 500, which is what he uses as his benchmark. And he's also created Acasio Capital, which is it's essentially a very, very, or what I'd consider a very, very high quality newsletter service, which is a paid service. We will talk about it later because it is one of the questions, but
Sure.
Do you want to just kick us off by just talking about how you became interested in investing in the first place and just your investment career today? And if you could also try and, I know that you did a degree and a master's, was it in that economics or finance? So yes, if you could talk about how you think they've helped as well, and also the job that you had as an analyst. So yeah, just from how you started to how you got to where you are.
Sure. So like everyone has a different story. Mine didn't really kind of start rolling until I went to university. Well, I initially went to university to study economics at the undergrad level. And during those courses in the first year or so, we had a few modules that were kind of centered around corporate finance, not really strictly investing, but the corporate finance elements of that interested me a lot more than the economics side. I've always been interested in data and had a natural curiosity as a person. So I think when we started learning about corporate finance and governance, that kind of piqued my interest quite a lot. So when you said I started in 2018, that's kind of when I started the strategy that I currently use today. I started investing a few years prior to that when I was in university, kind of early 2017. And that was just me kind of figuring out how everything works and, choosing a broker and kind of mincing around and experimenting. So yeah, during my undergrad is when I really kind of became interested in investing, and I didn't really have a lot of resources during my studies that kind of related to it. So that kind of led me to later taking the CFA, which was great for like a kind of ground level of some of the more technical aspects. And from that point, I think just kept that kind of passive interest for a year or so, and then just kept continuing to learn and kind of read a lot of books and find out who are some great mentors in the space. I didn't really have an ideology at that point. I was just reading the classic value investing textbooks, which I think is where most people start, the likes of Ben Graham and such. And then following that, when I graduated, I didn't really know what I wanted to do with my life, as I think most graduates do. They experience that. So I did a master's, and this was kind of focused around business management and innovation, which was really interesting. And it also led me to a lot of great books related to kind of disruption and the innovator's dilemma and all that kind of theory. During my master's, actually, that's when I enrolled in the CFA at the same time, which was quite tough to do both. And then when I left, I eventually got my first kind of quote unquote corporate job, which was a securities analyst for a private fintech firm. And in that role, I was mainly dealing with investment managers and big insurance clients. There was also some what we call corporate cash there, the likes of Spotify and Google. You work with those as well. Mainly just discussing their investments and kind of their asset portfolios. So that was interesting because I got exposure to a lot of different asset classes. Equities weren't really the focus for me. It was a lot of fixed income, derivatives, this kind of thing. So it was exciting at first, but then it quickly became boring. And then in March of 2020, or should I say February, just before the Corona kind of fiasco kicked off, I started a Twitter account just to kind of connect with like-minded individuals in my social circle. I don't really have that many people who are so interested in equity research, which is surprising considering the field that I'm in, but so it was. So I just wanted to find some like-minded people to discuss some things with. And then I found the handle investment talk with 2Ks because 1K was taken, just to kind of represent that's what I want to do, talk about investments. About a month or so after that, I started sharing some of my research. I'd been doing that personally for a number of years. I would be writing my own research on the companies that I follow and just kind of saving them in an isolated folder for myself to read at a later point. But when I first came to Twitter, I realized there was a lot of people there that were greener than I and didn't really understand some accounting concepts, which is by far and large my favorite aspect of it, digging through 10Ks and 10Qs and proxy filings and whatnot. But there was kind of a lack of understanding there. So I wanted to share some materials that kind of explained this in a jargon-free way. So the first thing I did was I wrote a book that was maybe 190 pages long. That was just kind of the introduction to feeling your way around a 10K, and that resonated with a lot of people. And then following that, I started writing the newsletters on a more frequent basis. And that was just something that I found that I was really passionate about. I have quite what I'd say is like an addictive personality when there's topics or things that I want to goals that I want to get finished. I'm quite ruthless in the amount of energy that I put into that. And, a byproduct of that is maybe ignoring some other aspects of life. But yeah, I found that I had this natural kind of draw and curiosity and passion towards writing, which I never thought was something that was kind of in my personality. I never thought of myself as a creative person, but it kind of just led from there. And then 1 year later, it got to a point where I could kind of support my life without actually having a full-time job. So a few weeks ago now, I left my full-time position, put my notice in, and I'm just doing Ocasio Capital full-time. And yeah, I'm excited to see where it goes 1 year from now.
There's a few things you've mentioned there. I just want to go back over if that's all right. So you mentioned The Innovator's Dilemma. Is there a reason that you mentioned that book specifically? And what sort of influence, if any, do you think that book's had on how you view companies and innovation?
I think especially in the tech space, The Innovator's Dilemma, I imagine you've read it or maybe not.
I have, yeah.
Yeah, but for the listeners, it basically focuses on kind of technology over the years, and it has a few great case studies. It focuses on chips, which is not an area I'm super knowledgeable about, but basically just how the big incumbent firm is always at a disadvantage because the newer upcoming firms, they're more nimble and they're able to innovate faster. There's less red tape. So there's this repeating cycle of big incumbents being taken over by disruptive innovators, which has always been present in the world. And it's something we see today, especially in the kind of finance space, with all these fintechs like Square and even PayPal taking over the kind of roles of traditional banks. So when I first read that was kind of a light bulb moment, and it just helped me understand the kind of dynamics of the market. In economics, we learn a lot about market structure and competitive forces and whatnot, but this book, although not super, well, it's kind of related to investing, but it's more about kind of market theory and how the dynamics work there. It just kind of switched a light bulb on for me and made me kind of gravitate towards finding those disruptors, or at least finding industries where there is a lot of disruption going on, and just kind of making you aware of, a big incumbent, something like Intel or Coca-Cola. Just because they're big and they pay a dividend, it doesn't necessarily mean that they're a great company to hold.
And then you talked about as well, just about how you started by sharing your research. How did that actually transition into a newsletter and the Substack that you're on now? So were you just putting everything out there for free initially, and then you realized people quite liked it, so you create the newsletter? Or
yeah, so initially, as I said, I just wrote a book. When lockdown first came, it was kind of surreal. I was working from home and I had a lot of free time. So I just started writing a book, and after about 2 months, I published it, and I think it was maybe $5. I gave a lot of them away for free, but people really resonated with that and said they like the kind of writing style and how it doesn't have a lot of jargon in it. So following that, I did actually start a newsletter in maybe May of 2020 or slightly earlier in April. And the premise of that was one per week, and it was kind of a roundup of the market, what had happened, and then also kind of a very small deep dive every week. But I found that didn't really work for me because I was working during the week and then trying to do all this at the weekend, and the kind of logistics didn't really work, and it became quite burdensome on my other aspects of my life. So after 4 weeks, I stopped that, which was a shame because people had already kind of supported me. And the immediate reaction personally when I stopped it was kind of regret. And at that moment, I was like, this is something I really want to do, so I don't want to give up on it. And then a month later, I discovered Substack, and the flow was a lot easier for me to manage. I was using Gumroad previously and just uploading everything as a PDF. But Substack, sending out the emails just felt a lot more natural to me. So I could write something, leave it, and come back to it the next day, finish it, and then kind of just snowballed from there. And there's been a few different iterations. I posted daily for about 6 months, and then I whittled it down to 3 times a week. And then I decided there is no fixed kind of structure. It's one kind of big deep dive report every month. And now just recently, because I have more free time from leaving my job, there's going to be a market update every Monday, and I'll be slowly adding things to it. But yeah, there's been a few iterations, but the biggest thing has been the support from people on Twitter and subscribers. Even when I was making these changes, I made sure to describe what I'm doing and kind of what the thought process is behind that and how it affects me and how it affects the reader. And surprisingly, people have been very supportive. Obviously a few people signed up for something and they felt they weren't getting the same deal. So they left, but that's, there's friction in change, and I think you have to make changes to grow.
Yeah, so do you want to just talk about Acacio Capital as it actually is now, so the newest iteration or the current iteration of the service? Because as a paying subscriber myself, what I like about it compared to the other services, so I am subscribed to a few different services, and what I like about yours is you're covering fewer companies, but you're covering them in a much higher level of depth, which is what I quite like. So you'll, for example, like if you'll cover a quarterly earnings and you'll do 40 plus pages on it just like that. And then you've mentioned your deep dives, and those are, I mean, the Etsy one was about 80 pages.
Yeah.
So do you want to just talk about that? And if you want to talk about your fee structure as well, that's fine. Because I think it's ridiculous value for money, to be honest.
Yeah. So Acacio Capital, from a tax standpoint, was just something I had to kind of create. Prior to that, I had a full-time job, and then I was also earning side revenue from a newsletter business. So that was being filed as self-employment. For those of you who are, well, I'm sure you're very familiar with UK tax. But basically, it came to a point where the revenues were sufficient enough that it was more beneficial to pay corporate tax than it was to pay income tax. And there's a big difference there. So I set up Acacio Capital as kind of the parent organization, so it could be a separate entity for myself. And then now everything from the newsletter, as well as a few other things, goes through Acacio Capital. So it's now its own business, and it's not really tied to me. So the income I generate from that now is through a very small salary and then dividends. So that was kind of the reason for that, purely just for tax efficiencies. And then when you said that I write the kind of deeper analysis on fewer companies, that's primarily because myself, I only really follow maybe anywhere from 15 to 20 companies very closely, and they'll be the ones that I'm invested in. So I publish one deep dive every month. That is not necessarily a company that I'm invested in. The subscribers vote for those. So last month it was Etsy, this coming month it's Pinterest, and then the following month it is Redfin. Just so happens I do own all of those three, but whatever the subscribers vote for, I'll be writing on. And the kind of rationale for doing deeper analysis as opposed to short, I know a lot of people like a 5-page summary, but it's just not my style. The ability to write 100 words or the ability to take 1,000 words and write it in 100 words is a great skill. And I myself kind of try to follow that mentality. But what's different about the way I'm writing is I'm not writing it to be a concise 2-page report. It's really to give someone a full understanding of the company. If someone had never heard of Etsy before, I want them to be able to read this body of text and then come away from that understanding all the levers in the business, understanding the history, the management, the kind of corporate structure, what the next year might look like. So it's really like a short book rather than, you know, 1 page. Here's the catalysts, here's the potential headwinds. Although I do include all that information there. But over time, I think I will slowly try to bring down the page count from 80, which was quite excessive. It nearly broke Substack. I had to reduce a few pages from there. But yeah, that's something I'm working on, making it a bit more concise. But I always have that overarching need to feel the need to explain a lot of these concepts in case there's a reader there that might not understand what something like deferred revenue is. I would always take a few sentences there just to explain what it is and kind of how it functions within the business. And yeah, the other reports when I'm writing about maybe Twitter or Facebook, they're just the companies that I follow. And I understand that maybe readers don't necessarily care about what Facebook are doing, which is why I don't really include the fact that I share that too much as a marketing perspective. You know, that's just like an ad hoc additional kind of bonus piece of research. You know, if you follow Facebook, it would be useful. If you don't, it might be less useful, but you would probably still get benefit from it anyway, because if you read through it, you'll find that it's my kind of thought process and understanding how the business is functioning, how they've performed, you know, my takeaways from what management is saying. So I think there's always little snippets to take away from that, even if you don't necessarily have an interest in Facebook.
The fee structure, you've got monthly, annual, and then a lifetime subscription, where the lifetime is double the annual. Do you? Yeah. I mean, I think you're over 5,000 subscribers now. Do you see yourself continuing with the lifetime, or is that something where you think if you got to a certain size, you'd get rid of it? Because I don't know, when I subscribed, because I already knew the quality of the work based on your Twitter, really, I knew it was going to be high quality. For me, it was just like, well, that's a no-brainer. I'm going for the lifetime. But then, I don't know, it just seems like too good a deal, if that makes sense.
I think candidly, and I think people would understand that, I think candidly, this is now a business and something I'm looking to support my kind of livelihood on. So the recurring revenue is obviously a lot more attractive to me. But in the initial stages, I'm still quite small. So lifetime was something to offer people great value, and they don't ever have to think about paying for it again. You know, I'm going to be writing here for the foreseeable future. I don't see myself ever not doing this. My whole plan is to kind of be able to do this full time, and now I'm doing that. And now I'm going to be able to pour 8 more hours worth of energy into this every day that was previously kind of given to my full-time job. So I think the lifetime in the initial stages was to have people that want to join in and be a part and, you know, discuss in the Discord and read everything and just kind of be involved in that for a lifetime, basically. At the moment, I have removed it.
Oh, right.
Yeah, I have removed it, but only temporarily, just because, so for every 10 people, probably 4 of them would be lifetime subscribers, maybe 2 of them would be annual, and the rest would be monthly, which is great to have that level of enthusiasm and support. But then from a business standpoint, it's not ideal when you're trying to build recurring revenues. So I think in the future, I'm going to be maybe turning it on and off at certain points of the year, just to give someone that kind of opportunity if they wish. Most people just reach out to me. I think you reached out as well, because of the way that Substack do it. They don't actually offer lifetime subscriptions, so I have to manually do it. Someone pays for the lifetime, and then I have to extend their subscription period to forever. So I was finding that everyone who was going to sign up for it messaged me first and said, is this a recurring payment or is it a one-time? I had to kind of explain that. But yeah, I think basically I'll be offering it on an ad hoc basis and going forward into the future, because it seemed like people were finding it the most attractive option, which is great. But I have to kind of reconcile that personally as well and kind of think about the business as a whole.
Yeah, no, it does make sense. Obviously, although you get the 2 years of revenue up front,
Yeah.
that's then it. So if they read your stuff for 10 years, it's massively skewed in their favour, which is probably why it's so popular. So do you want to just talk a bit about your actual investment appraisal process, and if you were looking at a new stock or a potential investment that you knew virtually nothing about, how would you go about doing that and becoming more familiar with the company?
So before that, I would usually have a look at the industry, or the way that I find companies. It used to be screening. It used to be a lot of screening. Now it's actually through a lot of communication with other investors and people that are smarter than I am. So if I'm interested in the commerce space, I'll typically ask a few people that I know that have kind of skin in the game in that space, ask them what their thoughts are, and then collect a bunch of companies I want to look into. I'll look into each one individually. But in terms of what I'm looking for personally, I have kind of a flexible appraisal process in that I'll either be looking for something that is leading in the industry and they have a significant moat, in that I don't think they're going to be getting penetrated anytime soon. Something like a Starbucks. You could argue there's a lot of small coffee chains and kind of artisan coffee shops that people favor over Starbucks coffee, which is true. I prefer that coffee. But Starbucks is still expanding in Asia. They're still growing. They're a loved brand. If you gave someone $50 billion, I think they would struggle to build a coffee brand that's going to overtake Starbucks in the next 10 years. So that's something I'm looking for, something that's kind of a stalwart in the industry. And secondly, something that is maybe growing to become one of those companies. So something that's up and coming, that's disruptive, that's going to be looking to take market share away from other people, or if they just have a new kind of angle on something that already exists. It could be something smaller like Etsy. They're still very young in their kind of journey and they're not really a top player yet. But if I think they have the potential to be in that top 3 space along with other marketplaces, then that would be something that attracts me. And then lastly, something which is kind of heavily devalued for no apparent reason or good reason, in my opinion. This is something that I don't do too often, but when it appears to be quite an obvious and strong bull case, I'll jump into it. So the most recent example of that was MGM Resorts back in March of 2020. Now, at that time, there were a lot of pickings that you could easily just have bought and then, rode 100% returns and then sold them. So it's not really any skill on my part, but I understood MGM for quite a while before. I'd never invested in it. I thought it was quite fairly valued, but then it plummeted down to maybe $6 or $7 per share. It was trading at the time I bought it for about 60 cents on the dollar in terms of revenues, which was arguably fair because they were going to lose about 90% of their revenues over the following year. But the thing that kind of signaled to me that this seemed obvious in my eyes was the liquidity was super strong. They could really just run their business for 2 or 3 years without ever having any additional inflow of cash. They had an ability to raise extra liquidity. Management had already kind of signaled that after the initial kind of disruption from Corona. So it was so cheap that I felt the kind of downside is somewhat limited. If you're buying, I ended up buying around $15, $16 a share. So I thought the downside was quite limited, and I was fully anticipating to be holding it for maybe 3 to 5 years. And then I was going to be selling it back at the kind of level it was at pre-COVID, at around $30, $35. And then 1 year later, it's trading for about 42 and I sell it. But that's kind of not something I'm not doing super often, but it's just if the bull case is pretty obvious, I'll jump into it with both hands. That's kind of what I'm looking for. And then the appraisal process differs depending on each of those kind of situations. So for something like MGM, where it's something that's devalued for no apparent good reason, what I'm looking for is the balance sheet has to be very sturdy. There has to be a good chance that they can raise additional debt. The management team has to be strong. They have to have proven to survive previous kind of periods of disruption, whether that be in 2008 or something a bit more recent, specific or native to the industry that they're in. So I'm looking for a strong balance sheet, and basically if they can run their business for 2 or 3 years until they get all these issues sorted out without really having any significant solvency issues, that's something I'm looking at. So MGM fit the bill, and I bought some. I no longer hold it, but it was a good short-term investment there. For the up and comers, something like Etsy or something like Square, I want them to be disrupting an industry, and I want to understand fully how they're disrupting it and why they're causing such an issue for the incumbents. So if you look at something like Square, their customer acquisition cost is very low. It ranges between $5 to $10. I think in the most recent quarter, they kind of marketed $5. It's probably double that in reality. But that's the issue there. If you look at something like Bank of America, they have branches all across the nation. That's just immediately driving up the customer acquisition cost. And then you have something like Square, which is just an app. It's based on an app, and there's so much functionality in there, and users derive genuine value from it. And it's all kind of seamless. And the rate of growth is insane. I think they have about 36 million monthly active users now. And I can't remember the exact metric, but it took Bank of America and JP Morgan many years to kind of grow that user base. So that, for that, I want someone that's growing well. I want to understand how they're going to penetrate the industry. And then all just the kind of typical, I want a good balance sheet, I want good management. It doesn't really matter if they're profitable in that stage, as long as I can see kind of a path to profitability and cash flows. Free cash flow is always nice. Sometimes it doesn't happen. What you find with disruptors is typically they're funneling all their available capital just through their operating expenses, and they're going to be losing. They're going to have no operating margin, no net income margin. That's because they're spending so heavily on whether it be R&D or marketing or whatever it is that's kind of implicit with that business model. But really, you're just kind of seeking to understand the kind of certainty that you think they're going to be X times bigger in X amount of years, which obviously comes with its own risks. There's a huge amount more downside there. The margin of safety is often not even apparent, it's invisible. And then lastly, when you've got a big incumbent, I'm looking at their moat and trying to understand why it's so difficult for companies to enter the market and take market share. Usually it's surrounding something, a big pivotal thing like branding. And you want to understand how important that is to their kind of stature at the top of the market. For something like Starbucks, they don't actually have a great balance sheet. It's quite awful, actually. And it's only gotten worse over the last few years. They have negative equity and all this kind of thing. But then the kind of overshining emphasis there is that I just don't see anyone taking over Starbucks in that space, and they're going to continue to grow. And the kind of reversal from COVID is already kind of shining through. In the most recent quarter, China actually grew 5% year on year, mostly because they're slightly ahead in the kind of the turnaround on Corona. They had it first, and they kind of quote unquote got rid of it first as well. So that's a good sign for the kind of the US and Europe. And hopefully the next few quarters, we should see that reversal there as the rest of the economy opens up. But yeah, that's kind of my 2 cents on the 3 things that I'm looking for, and then what I'm really trying to get from those 3 different levers that I'm pulling. And I'd say the most of my allocation is devoted towards the big stalwarts and then the up and comers, and usually anything from 5 to 10% in those kind of quote unquote value plays.
So you mentioned margin of safety there.
Yeah.
Do you want to just talk about firstly like what that is, and then why it's important to you, and how you'd go about determining what the margin of safety actually is?
Yeah, so there's a few different iterations of that, and for me actually it's not super important. It is important when you're buying something like MGM, but obviously if you were to have a look at all the stuff that I hold, you're a more value oriented person, might balk and say the downside there is pretty significant. I'm holding Square, whatever that is, 120 billion. It's just simply not worth that. The downside is way more apparent than the upside, in my opinion, right now in the short term. But over the long term, I think it kind of shifts a little bit there. But the margin of safety concept is basically, if you take something like MGM and it's trading for $6, and then you kind of work out what the company's worth at that point in time and what you feel its fair value is. So what the market's valuing it, the market cap, and then what you feel the fair value of the business based on the kind of existing assets. And if you think, hypothetically, say MGM trading at $6, just say its market cap's 6 billion, and you think the company is actually worth 15 billion just based on the assets alone, that's your margin of safety. So if you liquidate everything and there's actually more worth in the company than the market's giving it, that's kind of your margin of safety there from that market cap to the estimated fair value. So if you're buying something for $6, which you feel is worth, 15 billion when it's trading for 6 billion, it's that kind of, the downside is somewhat limited in that sense. And there's some investors that strictly just look for that. And then there's some investors who ignore it completely. It's not really my area of focus, but it's something that I do take into consideration in the short term. And in the long term, it's really less of a factor.
So when you've gone through all this process, on average, how long do you think it takes before you've done enough research and you're comfortable enough to actually start a position, or does that just vary from company to company?
I think it varies, and it depends who I'm speaking to. If I'm speaking to a few people that have sent me their own work and it's really great and I can kind of understand it, and I'll go and do my own work, it could be anywhere from 2 weeks to 2 months. There have been positions where I've been researching the company and the kind of the competitors, and within about 2 weeks, I've taken a small, tiny little position just to give me that kind of benefit of having skin in the game, so I feel more incentivized to continue researching. And then there are other times where I really just feel that I don't understand the industry well enough to take a position, so I'll spend a bit more time on it. But I would say anywhere from about 2 to 2 months.
One thing I've always found quite difficult is if I put a lot of work into analysing a company, I find myself almost looking for reasons to buy it, because you don't want the work to have gone to nothing. So how do you feel about, situations where you put 2 months of work into a company and then you get to the end and you just think, well, I'm still just not comfortable with this? Does that happen? Or
that happens? It's just a sad reality of the kind of opportunity cost of allocating so much of your time into researching a company. You could look at something, spend maybe a month or two ruminating on it, and then decide that it's maybe not a good idea, or you just simply don't understand the kind of bull case well enough to be able to be comfortable to take a position. That happens, and it feels like a waste of time. And you really have to be aware of your own biases. If you feel more incentivized to take a position just purely because you've researched it a lot, then that could work in your favor, it could not. It really just depends. It would all just be kind of hindsight, but that's something you should actively seek to avoid, as well as, if you're excited about a company before you even read the 10K, then you're going to be reading everything with rose-tinted glasses, and you're going to be kind of overstepping a lot of the red flags that you might otherwise be a bit more conservative about. So a big part of investing is just mentality and keeping your kind of biases in check.
How much do you read, and what are the best books that you've read on the subject of investing, or not necessarily investing, but that you think relates well to investing?
So I read quite a lot. I used to read a book a month, and that was my goal. And this was prior to me starting to do the Substack thing last year. So over the last year, I've not really been reading as many books as I used to.
Switch to writing a book a month instead.
Yeah, exactly. But I actually leave my job at the beginning of May, so obviously that clears up 8 hours a day. So my dream is just to be able to wake up at 6 and just read unconstrained for 2 or 3 hours in the morning. So I'm going to be doing that a lot more. Basically, at the moment, I'm more so reading research reports and kind of articles as opposed to books, because I feel if I'm not using that time, of which I have so few, if I'm not using that time, then it's wasting time towards me creating content. But when I actually leave my job in May, then I'll have a lot more free time to start reading again. So I'm going to be picking up books once more. So I'm an avid reader, and some of the best books that I have read, I think the first book that I ever read was The Intelligent Investor, which I think is a lot of people's first book, by Benjamin Graham. And that taught me a lot of lessons about the mentality side. I don't really take the value approach. as you'll understand. But the mentality side of it really resonated with me. I'm glad it was the first book I read. I think everyone should read it, even if you don't necessarily understand what's being spoken about. All of the aspects of your biases and mentality can be understood, even if you're not familiar with investing. The whole Mr. Market concept and holding through volatility really resonated with me, because I don't really have that emotional pull when I see something that's down 20%. That kind of gets me excited most of the time, which some people would say is ludicrous. Some people would say, yeah, that's correct. And it's all just perspective. But I think that was my favorite book on mentality. And then Philip Fisher is also great. Benjamin Graham's other books are also great. Security Analysis is good. It's very dense. I've only read it once, and I'm planning to reread it in a couple of years when I can understand it a bit better. Philip Fisher is really good and a lot more jargon-free. Common Stocks and Uncommon Profits is a great book, which kind of just outlines what kind of companies you should look for, when you should buy them, when you should sell them. And Philip Fisher says if you've done the research correctly, the time to sell should be never, which is a great quote, obviously a bit flawed. I like also reading Aswath Damodaran, probably murdered his name, but he comes from the place of kind of discounted cash flow analysis, and that really helped me when I was doing my CFA, reading his stuff. And he's just kind of no nonsense, tells it how it is. I also like Mark Minervini, probably murdered his name too, but he just comes from a different kind of world than what I'm used to. So he's all about managing risk as the top priority, using stop losses, very short-term trades. He'll take 5-10% on a trade, move on. That's not my style. I think it's always important to kind of understand other approaches to investing so that you can improve your own. There's a lot of technical analysis there, which is something that I don't use too often, but I always enjoy reading about it. Outside of investing, I like reading stuff that's kind of related to markets, but then not specifically related to, how to invest. So I mentioned The Innovator's Dilemma, which is a great book. Stress Test by Timothy Geithner is one of my favorite books. I absolutely demolished that in the space of about a week, and it's quite a fat book. Basically just his perspective from the inside of the financial crisis, which he had a huge part in kind of putting the fires out, if you want to say that. That was really interesting, taught me a lot about kind of the destructiveness of market crashes and how they kind of embed themselves into the market, and how they get resolved, which was really interesting. And I also just love autobiographies as well. So I have quite a few. The first one I ever read was Richard Branson's, representing the UK. His was really interesting. He's just started like a plethora of different businesses, from airlines to kind of media to everything. And his kind of entrepreneurial spirit was really great. And then Shoe Dog, Phil Knight, Howard Schultz. I like just reading the backstories to help people start great companies. I always think that's interesting. I don't really read a lot of fiction, so that's something I want to change. And the most recent fiction book I read was Sevences, I think it's pronounced. Basically, the moon blows up, and it's just about how humanity deals with that. I think even though it's maybe not related, you won't finish it and think, oh, I know how I'm going to move this into, or like translate this into my investing approach. But you read it and it gets your creative juices flowing, and it makes you think about things differently, which I think in the long term compounds itself in your own kind of personality, and your investing style is just intrinsically linked to your personality. So I think it always has a benefit there.
I'll actually be adding Stress Test to my reading list, because
it's great.
Sound like the sort of thing I'd like. I'd never heard of that one before, actually. So how much of your focus is on the US listed stocks compared to the UK, and what do you think about general valuations in the US compared to the UK?
So for me, I'd say like 90% of my allocation, 100% in the core portfolio, which is just the one where I'm just holding individual names, and the one that I focus on most, that is all just US based, with one exception in Sea Limited, who are in Southeast Asia. But yeah, that's US based. So on a few different levels. So I understand kind of GAAP accounting a little bit better. and I learned US GAAP accounting just through CFA, which is a small part of it. I mean, I can just read them and understand them. And then the UK also has GAAP and IFRS. But just on a market perspective, I think the UK is just less exciting for me. There's no companies in there that are going global or disrupting something on a global stage that have kind of a good footing in the global market. The tech space is really not that interesting as well. It's kind of just full of, consumer discretionary, energy, old, beaten down finance, industrials, and it's just not that exciting for the kind of allocation strategy that I want. I do look in the UK. Probably every month I'll spend a good period of time checking out 2 or 3 different companies. I was having a look at the real estate space with Rightmove or Your Move. I can never remember which one's public. I think it's Rightmove.
Rightmove, yeah.
Yeah, I was having a look at them. Diageo, I was having a look at them. But it's just, they're great companies in the UK, but then on a global scale with the international expansion, it's just kind of missing what I want. Diageo is obviously international, not relating to that. But I think the US trades at a premium for a reason. If you were just to compare the UK kind of valuations to the US, you would say the US is a lot more expensive. But then if you look past the last 30 years, it's always been more expensive and it's performed way better. I think the companies there are just more exciting. There's a lot more disruption. The entrepreneurial spirit in the US is a lot greater. In the UK, it's kind of different. I don't like making sweeping statements, but in the UK, like if you try to create something and fail, there's kind of a stigma attached to that. Where in the US, if you fail, it's celebrated and it's praised and you pick yourself up and move back on. But in the UK, it's kind of a different culture there. I think it's slowly changing. Maybe the Deliveroo IPO flopped, but it's a great tech company. I don't particularly like it personally, but it's nice to see more tech going through the London Stock Exchange. So yeah, comparatively, the US is trades at a premium, but I think for a good reason. And most of the reason why I don't really invest too much in the UK as much as I'd like to, because of the obvious currency benefits, it's just because there are no companies in there that really excite me to the extent that I'd want to have them in my portfolio. I have invested in a few UK-based companies before, mainly smaller cap, but I don't hold any currently.
Do you think the different attitude towards failure and entrepreneurialism is part of the reason that the UK doesn't have a tech sector, or as much anywhere near the level of a tech sector that the US does?
It's a good question, and obviously there have been examples of great entrepreneurs from the UK, and there are a lot of promising young startups here. Well, I shouldn't say startups, they're kind of growing into fruition, kind of a big company like Deliveroo just went public, all that kind of stuff. So yeah, I think there's kind of a hotbed of great younger companies there. But in terms of the tech sector, I just think the infrastructure is set up in a way that it's easier to kind of grow something over in America, whereas in the UK, the enthusiasm towards it is just a lot less. I don't really know what it is, whether it's the kind of mentality of the people creating the companies or if it's the kind of just purely the infrastructure in the US just kind of allows for the creation of tech-based companies to kind of come to fruition a lot faster and a lot more aggressively, whether it's that. But the US are just great at innovation, and the UK just doesn't compare at the moment.
What are the best resources you use for investing? And they can be free or paid resources.
So I use quite a few. I've always used YCharts just for data. I just find it very easy. If I need to go find something or just quickly scan a company, I could just jump on YCharts and chuck in the ticker and find everything I need pretty quickly. So I use YCharts for a lot of visual stuff. That's paid, and I forget how much it is, but it's not a ridiculous amount. Koyfin, on the other hand, if you've used them before, they're a free tool. I don't think they'll always be free. I think eventually they'll start a premium aspect of it, but they're probably 80% of the way there towards being as good as YCharts. I just prefer YCharts because it's a lot more intuitive and I'm used to it. But Koyfin is a great alternative to YCharts if you don't want to pay for something. In terms of charting, data, financials, ratios, everything, it's 80% of it is all on Koyfin and it's free. So I use those two quite a lot for different things. I subscribe to a few different newsletters and Substacks and kind of institutional research reports, if you know someone that can get you all of those. So I read through them quite often every morning. And there's a mixture of paid and free. Yeah, I think the biggest tool that I use is just the kind of the SEC filing page on the investor relations website for a company. That's my go-to. And then if I'm looking for a quick scan, I'll use Wirecharts. My tools, most of them are free because I'm really just, reading stuff on my own, or I'm just communicating with someone that's maybe 10 steps ahead of me on a particular industry or a company, and I want to gauge the kind of quick 2-second perspective on what I'm jumping into. So a lot of that's communication. More so now because I've made so many connections through growing a Twitter account, which is great. But previously it was basically all just me reading SEC filings and stuff like that. But yeah, I'm probably going to be missing something, but I just can't think of any right now. Other than that,
Are there any Substacks in particular that you'd recommend then?
yeah, I think Teddy, he has a great Japanese small cap portfolio newsletter where he just kind of dishes out pretty frequent overviews of small cap Japanese stocks. I forget his second name, so sorry about that. Chris Seifel, he has a great one. He just does monstrous in-depth reports on everything from kind of AI to semiconductors, which are spaces that I don't really read about. So it's great to jump into those. I can spend maybe like an hour or two reading through some of his stuff. It's really mind-blowing, really good. He releases a lot of free stuff, but of course there's a paid one as well. Non-Gap is good, Mike from Non-Gap.
So what was the Japanese one? Was that Hedy or Teddy? What was that? What was the name of that one?
Teddy, let me just pull that up. Yeah, so Teddy Okuyama, probably murdering that name, but his Substack's called Mother's Market. He recently just changed it to that name, but it's basically every week he'll send out just a quick company overview of a small cap Japanese company. And for me personally, that's an area that I actually do spend quite a lot of time in. So it's great for me just to kind of get ideas. It's a great one for generating ideas. If you're not really familiar with the market so much, to know which players are moving or disrupting, it's great just to have that into my inbox as, a potential thing to chuck on the watch list and then have a look at myself. So I've really enjoyed that one.
Who do you look up to as an investor, and where do you get your inspiration?
So when I was kind of younger, I didn't really have any family or friends that liked investing. So obviously I wasn't really exposed to it until I started going to university when I was 18. And even then, I still didn't really have any acquaintances who were that interested in it. So for the first 4 or 5 years of my decision to kind of undertake the educational side and start, educating myself, I didn't really have anyone that I could relate to or discuss it with. So it felt kind of isolated in that sense. I was just reading books, finding a broker, trying to read 10Ks on my own, trying to understand accounting better. And yeah, for the first, 8% of that journey, I just didn't have anyone to kind of look up to or discuss ideas with or really relate to. So even to this day, I don't really think I have anyone I look up to in particular. I love reading about, Graham and Fisher and all these great investors, but I don't necessarily see them as role models or someone who I, take a lot from in terms of style, which isn't me, being arrogant or ignorant. It's just how I feel.
Do you think that's because you're taking little bits from lots of people instead of primarily basing your strategy? It's not like you're saying, well, yeah, I'm just going to go down Graham's route. You are picking and choosing from loads of different sources. Do you think that's part of the reason?
I mean, yeah, I think so, because like with the Graham stuff, like I took a lot from him about mentality, but not necessarily about stock picking, like cigar butts. Although I do like the occasional cigar butt, but it's not like a big part of my style. Buffett, I think everyone just learns a lot from him, whether they understand that they are learning from him or not. And then Fisher, he was just like, everything he said was very simple. It was very clear cut and understandable, and just keeping it simple is one of my biggest philosophies. I think, if you're undertaking 100 hours of research, which is very excessive, but say you want to find out more about Etsy, and you say, I'm going to spend 100 hours on it. I think in the first 10 hours, you've probably learned 80% of what you're going to absorb. Anything after that is like, it's either an overload of information, or it's not compounding the total understanding. So I think keeping it simple and just understanding the key catalysts, the key headwinds in the business. Took a lot of that from Philip Fisher, and scuttlebutt as well. That's a great word, and it's a great kind of philosophy to have. Just trying to find information from alternative sources that you wouldn't find in a 10K. And yeah, so I'd say I'd probably take a little bit of it from everyone in that sense.
Which Twitter accounts would you recommend following the most?
That's a great question. And honestly, I know it sounds like a cop-out answer, but if you just go to my following list, and all the people that I follow, I would recommend. I'm quite picky in the people that I follow. I like to have people that kind of tweet and interact quite often. So that's a big one for me. Or if they don't tweet and interact so much, if the quality is really great. I like following people who kind of have alternate opinions to me. People that, Facebook's my biggest position. I like following people that hate Facebook because it keeps me in check, and it stops me from running away with my own confirmation bias and, reading posts about Facebook's great and then just confirming it in my head. So I'd say just all the 160 odd people or more that I follow, they're all worth a follow in my opinion.
I do think that's like what you've touched on there is actually a really good thing to do on Twitter. If you do find yourself really liking someone on Twitter and engaging with their tweets, I think going down their follow list can be such a useful thing, because you'll probably like a lot of those as well.
Yeah, I think so. I do that quite frequently. If there's someone, that I like or respect or whatever, I'll see who they're following and try to pick out a few interesting ones. It's just great for discovery as well. And then also with Twitter Spaces now being a thing, I've been finding a lot of great people to follow just based on someone that I follow having a space, and then they have a speaker in that space who is someone they appreciate, and then you get firsthand audio kind of experience of what their thoughts are, and it's great for discovery that way.
How do you think about your allocation and position sizes? And in particular, would you stop adding to a position when it reaches a certain proportion of your portfolio and then let it run, or would you trim or that sort of thing?
This is something that I'm still personally kind of working through. I do have some rules, but I don't like to be too kind of rigid, because there's a big opportunity cost in trimming winners too early or selling them too early, or that kind of thing. But typically I would like to put most of the weighting in the kind of the ideas that I feel have the I don't like saying conviction, but like I feel personally have the kind of best risk reward profile there. So Facebook was one of my biggest ones for that reason. And otherwise, I don't really like having too much allocation towards one particular space. And if I'm starting a new position, I don't typically make it any bigger than 5%, which is, the complete opposite of what some people say. And they're saying, if you're starting a position, you should have enough conviction in it so that you're comfortable making it 5% of your portfolio, which I fully agree with. And I think that's a great one to go by. But for me personally, I like taking a 0.5% position or 1% position in something that I've done half the legwork on and I'm still researching, but I want to have kind of skin in the game to kind of help me feel the company a bit better. That's just my approach. It's probably not the most efficient approach, and a lot of people would disagree with it, but it works for me. And yeah, I think kind of holistically, I would just say I wouldn't like anything to be more than 20% of my portfolio. If it grew to that size, then I'd probably consider trimming it, maybe pulling back 5%. I think it's important also to kind of remove emotion from your allocation process. If you just like a company, you need to be aware that, when you're looking at a company, you're not just looking at the financials. In your mind, you're also subconsciously kind of resonating with the brand and the leadership and the confirmation biases that you have and how many other people like the stock. Subconsciously, you might not actively think that, but subconsciously that's what's going on in the kind of the wires of your brain. So you need to kind of be aware of that and remove the emotion from the allocation process. I don't necessarily like Facebook as a company. I don't use it. I use WhatsApp and Oculus, but I don't like the Facebook app. I don't like the Instagram app. And it's still my biggest position. I do like management. But I think even when you're trimming and selling, you need to remove the emotion from that. You shouldn't have too much in your mind of, if I sell this now, what if it rips another 20% in the next year? That's something to consider. But it shouldn't be the kind of the pivotal, input to your decision to sell or buy something. If I decide that I want to sell something, it's usually very quick. Obviously, a lot of thought goes into it prior, but the action of actually selling it is just, we're selling it, we're getting rid of it, let's move on. So I think trying to remove the emotion from that and just be rational is the best approach, which is easier said than done because humans are obviously not rational beings.
What you talked about like worrying about it going up another 20% after you've sold it is a really good point, because I was watching one of the old Berkshire meetings, must have been a couple of months ago now, but Buffett got a question about that. And he basically said, like, if you're actually doing your work and you're picking good companies, you should expect them to continue to do well after you've sold them. And if they're not doing, that should concern you. And I think it is important to bear that in mind. So yeah, I do think that's a really, really good point.
A few weeks ago or last week, I sold my position in CrowdStrike, the cybersecurity company, and a lot of people kind of gave me a bit of flack and joked about that, and it's since went up. Since went up about maybe 10-12%, and so people are like, you just lost out on 10%. It's not quite as clear cut as that. I would probably be sleeping better. The stuff that I've reallocated into have also went up, so you have to consider that. But yeah, what's white for someone might be black for someone, so you have to take that into consideration. My decision to sell was not based on how popular it is on FinTwit, so it's all just kind of perspective.
Yeah, especially if when you're selling, it's not you saying this company will never be worth more than it is right now. That's not really what you're saying when you sell, because obviously, like you say, you sell for lots of different reasons. So if you're sleeping better at night, then that was obviously the right decision, even if it continues to do well, which it hopefully should do. If you bought it thinking it was a good company and you sold it thinking it was still a good company, there's no reason why it wouldn't. Yeah. So what do you know now that you wish you knew when you first started investing, and what advice would you give to yourself when you were just starting out?
I think when I first started out, I made all the classic mistakes, investing without doing research and kind of trying to speculate based on what might happen in a month or two. So I think the biggest thing, if I was to go back to myself at 18 and say, what you should be doing, I think just patience and taking your time. If you're really excited about a company, don't just jump into it. Take some time to really, make yourself unexcited about it if you have to. Read up on the competitors, read up on the industry, understand the business, understand the levers, because I think it's quite easy when you're excited about a company, you put the bias lens on and you kind of fall short in other areas of your research process. So I think the biggest one, if I was to go back and tell myself, would just be, kind of remove the emotion from the research process, for sure.
How have you evolved as an investor then?
I think, well, maybe holistically, a few different things. I think when I first started, I was kind of investing based on trends, which is still partly true, but it's less speculative trends. Like the first ever investment I made was in cannabis in 2017, before it was kind of legalized in Canada recreationally. And that was basically the only thesis, was just Canada's gonna create legislation to pass to allow it to be recreationally sold, and then the industry would have some kind of boom, which actually did play out, but it was like a naive assumption. It just so happened to work out that way, and there was kind of a huge boom and then a huge bust, and now it's only really recovering and kind of picking up speed now in 2021. So I think that was a big thing for me. Now it's less, less based on that kind of insight. I think now I'm able to, take a position without it really being so popular. I hold some stuff that people don't see any value in, or they don't really understand why you'd hold it. I'm comfortable kind of shrugging that off, like water on a duck's back. I think the biggest strength for me now and how much I've evolved is the emotional side. I don't think anyone is, but, I'm not the perfect analyst or the perfect investor. I make a lot of mistakes, but I think the biggest thing is understanding when you've made a mistake, why you've made a mistake, and kind of how you could have altered that to kind of push that in through to your evolution as you continue going down the path. And just the emotional side, the volatility doesn't really affect me so much, which, some would say it should. Some would say you should have stop losses. But I just think the mentality aspect, one of the things I was proud of in 2020 was when March hit, and it was, pretty severe. As I think the S&P was down about 31%. But my mind state was just kind of coincidentally, I just had a lot of capital on the side that I'd been saving and hadn't put into the market, just pure luck. But the amount of capital was like equal to the actual total amount of my portfolio. So I was essentially doubling the size of my portfolio during the March crash, which was just lucky. So I think my mentality at that point in time was just ignore the red and just buy quality companies that you think will survive any kind of impact that comes from this lockdown. So I started doing that and buying quite heavily, picked up a lot of companies that I've been wanting to buy that were now effectively trading at fair valuation or just ridiculously cheap. And it wasn't, an emotional process. It was just allocating the funds to the companies that were already on my watch list that I'd already spent time investigating. And I was fully prepared to, be underwater for, several years, but my time horizon stretches, way past 10, 20, 30 years. So I was prepared to kind of take that beating, for the next few years. And then, what happened. And, we traced the losses very quickly. And it was the fastest kind of retracement of a bear market territory environment in history. But I couldn't have had the foresight to predict that. I was, was fully expecting to be buried for maybe 2 or 3 years. And then, whenever the impact of the coronavirus kind of left the market, so I think the emotional side is how I've grown the most.
What are your thoughts on diversification and the negative impact it can have on your returns, because you effectively become closer and closer to being your own index fund, versus concentration, where you up your returns, but you are increasing your risk because you do need to know the companies incredibly well if you're going to have so few of them? And how do you balance the two, especially in relation to your own portfolio, where your top 7 stocks make up 60% of it?
Yeah, I think concentration is like the best way to earn outsized returns, but it's also the best way to, destroy all of your capital. And it's probably the biggest capital preservation risk, aside from using derivatives and whatever, that there is. I know some people that have over 60% of their allocation in one stock, which is ballsy, and respect to them, but it's not something I could do personally. But it depends on your quote unquote conviction and all this kind of stuff. But diversification is obviously good. I think you can go a bit to extreme, and it depends on what your kind of process is like. If you're working full time, you don't have a lot of time to research companies, and you don't really have a lot of time to follow the earnings reports or the quarterly reports. I think diversify yourself up to the nines. Hold as many companies as you feel is appropriate, that you can, with like relative amounts of efficiency, track to some extent, even if you're just flicking over the headline figures. It really depends. But I think if you don't have the time to buy individual names and follow them, you should really just index or pick a bunch of companies at kind of a low commission cost and spread your bets and do the coffee can approach or something like that. I think when you start getting past maybe 15 to 20 different positions, then the added benefit of diversification of each additional company, there's like diminishing returns there. You're just basically spreading out your returns over a greater number of companies. while you're not really reducing the kind of volatility or the standard deviation of the portfolio. So I think for me, a sweet spot is anywhere from like 15 to 20, which is something that I always try to stick by. If you've got 30, 40, 50, that's all well and good. So there's been a huge list of managers that have owned hundreds of stocks and performed very well over a period of 2 decades. It really just depends. For me personally, because I put so much time and energy into actually following the companies, I don't feel like I have the amount of free time that I'd like to, follow 30 companies to the level of quality that I would like. It would just be too much. So I'm just more focused in having a bit more concentration. I currently hold 15 names, and that's fine for me. And you also have to consider that I'm actually quite young. I'm 25 this year in June. And if I was to lose every single penny of my portfolio, whilst that would be devastating, it's not going to be life-changing. I could probably build that up, over the next few years again and be back at where I was. So you have to consider that. Where if I was in my 50s or 60s and I was getting to a later stage in life, my focus would most likely be on capital preservation. I wouldn't be putting 15% of my wealth into Facebook, or probably be a bit more spread out. And my investing process would likely change based on my circumstances, which is something you always have to consider when you're kind of looking at 2 different people or 3 different people and trying to understand their allocation strategy and how that works for them. So yeah, it really varies. But for me personally, I think when you get past a certain number of positions, the benefits of additional company kind of don't outweigh the benefits of just sticking to your higher conviction plays.
What are your thoughts on adding to your existing positions then, in terms of adding to winners and adding to losers?
Yeah, so there's a lot of talk about, like average down when your company is getting beaten, or average up when your company is doing well. And I agree with both, with obvious asterisks attached. So if you have a great company that just gets beaten down for some kind of nonsensical piece of news, when advertisers pulled from Facebook in 2020, something like that, it corrected 10%. The business is still solid. The advertisers came back within 3 quarters or something like that. So in the long run, that was an opportunity. But if you've got something like, I don't know, say hypothetically, you've got Coca-Cola or Starbucks, and Starbucks decide they're going to shut half their stores nationwide and close them down and write off losses, and just say the stock tanks 30%. That doesn't look like an opportunity to me. That looks like a business that's struggling, and trying to, lower their fixed costs and bring capital from somewhere to fund some other aspect of the business. So you have to kind of put on your investigator's cap and understand, is this an opportunity, or is this kind of a red flag as towards where the business is heading? So that relates to kind of averaging down. So I will average down if the price is there for some kind of weird reason. I held Apple at a split adjusted price of 56, and then during March it got close to that level. I think that would be a great time to just pick up some shares. It's a market crash. Apple are probably quite highly likely to survive through 1 or 2 years of underperformance. They have a big balance sheet that they can splash around. Same with Google, Facebook, all these big companies with ridiculous balance sheets the size of countries. But then so you have to consider that on a kind of contextual basis. And then on the averaging upside, I think you need to look at it and even averaging down, but you need to look at it if I bought a company 2 years ago at price X, and 2 years later I'm considering buying it at price Y, and it's 50% more. They're 2 different companies. You have to look at, what was the company valued 2 years ago? What's it valued at today? What's changed? Is there new business vectors they've taken? Has the margin expanded? Is there different management? Are they in new markets? Are they growing faster or slower? What's the kind of installed base of consumers like? How much money are they pulling from each user now versus 2 years ago? What's the run rate? You need to consider them as 2 separate moments in time. I think one great skill is being able to look at a position in your portfolio that's maybe up 100 or 200%, and being able to add into that without anchoring yourself to the cost basis that you have, which might be quite attractive, you really need to consider them as two separate kind of entities at two separate moments in time. So for me personally, a lot of my examples are from March, but it's just quite an active period of time. I'd been looking at Square for quite a while, and during March it just got hit on the top of the head, and I think it was trading for about $67 or something when I picked up. Okay, so that happened, and I picked up a small position, and then a few months later we had I forget which one it was, maybe Q2. There was a quarterly report that came out, and the indication was that the seller business, for those of you who don't know, Square has this kind of Cash App business, and then they also have this seller ecosystem where they provide point of sale and software towards small business owners and large enterprises. And the seller business looked like it was going to get hit very hard from Corona, from the lockdowns, but the Cash App business looked like it was going to accelerate during the lockdowns. And then obviously when it reopened, that kind of dynamic would in theory reverse. So it was a good lockdown and reopen play. But basically in this quarterly earnings report, the seller ecosystem didn't get hit as bad as what everyone thought it would. And management said they think that it's going to be manageable over the period of the lockdown. So even just in that space of 2 or 3 months, I think the price was at about $85. And I'd already bought some for 67, but I was fine averaging up because at that point in time, when I first bought some, there were fears over the seller ecosystem. And then when the quarterly report came out, those fears had kind of been alleviated. So I was happy to kind of add a bit more exposure. So averaging up was, in hindsight, good at that point, because obviously now Square trades for a ridiculous valuation. But I think when you're looking at two different points in time, you have to kind of forget about your cost basis and forget about how many percent you're up, whether it be 10, 20, 100, 200, because they're different businesses. You're not paying for the business that had X amount of customers 2 years ago and it was growing at whatever. You're paying for a company that has X amount of customers times however much it's grown. You have to kind of keep your emotions intact and understand that you're not buying the same company in theory here. So that would be my thoughts on kind of averaging down versus averaging up.
You're talking about how the two different companies, you did, I think you did, so correct me if I'm wrong, but you did an analysis recently. Was it Starbucks in 1999?
Yeah.
Yeah, so you basically analysed Starbucks based on the 1999 results as if nothing since then had actually happened. So how useful was that as an exercise, and what did you get from that?
So I think obviously it's hard to do because you know how the story played out and that Starbucks grew. But when you look at Starbucks back then, it would have been touted as kind of an exciting potential global expansion coffee store, disrupting the coffee market, because prior to Starbucks really revolutionizing coffee in the US, and I know some might scoff at that, but that's generally what they did prior to Starbucks and this kind of like, sexy coffee environment. People would drink low quality coffee and it would cost, I don't know how much it would cost, but it'd be very cheap and it'd be kind of nasty. And there wasn't any kind of pizzazz or sex appeal to drinking coffee. It was just something you did to kind of, get yourself through the working day. And then what Howard Schultz discovered when he went over to Italy was that there was this whole kind of, environment dedicated to espresso-based coffee bars in Milan and elsewhere in Italy, where people would come at the lunch break for 20 minutes, stand at a bar, order a coffee, drink it, and then get on with the day. The quality was good. There were different kinds of coffee. And that just didn't exist in America. So he brought that over to America, and obviously with the franchise model, exploded worldwide, nationwide, and then worldwide eventually. But I think the narrative at the time was that was going to happen. They wanted to expand across the nation, but then, there's uncertainties. People say, well, Italy's different to America. Maybe they like coffee. We just don't have that culture here. So there'd always be naysayers and doubters that could happen, and maybe correctly so. And Starbucks traded at quite a ridiculous premium back then. So if you were buying it back then, you know, it was an expensive stock and it was quite volatile as well. And it didn't really get unexpensive or fairly valued until it really grown into its size and, you know, became what it is today. So I think if you're looking for companies like that with those narratives, you have to be willing to pay, you know, an excessive premium to own them and potentially capture all those gains. But that's kind of the flaw of having survivorship bias. You know, for every Starbucks that actually conquered the world, there's probably 10 other different franchise coffee stores that never made it, or that maybe didn't grow to the extent that they did. But yeah, it's definitely interesting to go back. Another exercise that I actually like that Austin Lieberman, previously at Seven Investing, now at, I can't remember the name, Social Capital, something like that. He likes to routinely go through S1 documents, S1 filings for companies that have since grown, you know, significantly large. I think at one point he was looking at Salesforce, and you know, that was a really fun exercise that I saw him doing a year or so ago, and it's something that I've brought into my own process, more so for curiosity. You know, if I'm researching a company, the first thing I do is not really go look at their S1, but if I want to understand a big company that's became huge and what their origin story was, I'll typically go back to their S1 and try to just read it without, you know, try to read it without bias and see what people saw in it then, and you know, try and understand the mind state, that the kind of market sentiment was back at that period in time. But yeah, if you go back and look at Starbucks' 1999 report, you know, they were growing pretty quick. They didn't make any money. They were burning through cash. They just had this mass kind of expansion strategy. They had great management, and they had some big lofty goals. And if you were on board with that, you would have made, you know, a very handsome return over the following 2 decades. But you know, it's a great exercise to do, and it kind of takes you away from the current day, you know, choppiness of the market. You can just go back to 1990 and just, you know, read about Starbucks before they were big. It's fun as well as, you know, kind of insightful and educational.
So the next stage of questions are going to be questions about your actual portfolio. So this is based on, so on your Substack, you post updates quarterly. So, yeah, so this is based on the last quarterly update, and it's also based on your mission statement that you've got posted on there as well, in case anyone wants to actually go straight to the horse's mouth. But yeah, so you've got a mission statement for your portfolio listed on the website, and that reads as follows: to hold a reasonably concentrated basket of companies in an effort to compound the long-term value of the portfolio. The value proposition of each company, as well as the company itself, should be well understood and within the confines of the selection criteria. Buying great companies at reasonable prices that can reasonably be expected to dominate or penetrate their current market. Primary focus should be geared towards the advancement of fundamental strength over time, with respect to the company as opposed to the relative performance of the common shares in the interim. Could you just talk about why you chose those things in your mission statement, and also why you think a mission statement is important for investors to actually have themselves?
Yeah, so I wrote that just to kind of have, you know, like I think in the newsletter that I posted in that, I said that it should be like a baseline for the ensemble of musical instruments, and that, you know, it's kind of understated, but it's present throughout the whole piece of music, and it kind of guides where all the other instruments go. So it's good to have a baseline or a mission statement that you can revert back to at some point in time when you're feeling a bit lost, or you feel you've strayed away from your core process. And for me, basically, that just means understanding the companies that I'm buying, making sure that they're, you know, aligned with the kind of companies that I want to actually own and follow, and reduce the kind of importance of how they perform in the market in the short term. And I think having a mission statement is just important, you know, from the perspective that you should know what you want. If you're just investing without one, or without an investing policy statement, I think you are more likely to, you know, be swayed by external influences. You know, if there's some kind of sector that's heating up, you might jump into that. Or if there's someone whose style you appreciate, you might just start subconsciously mimicking that and moving away from, maybe if you are focused on yield, you might start focusing towards growth, and then you might start focusing towards semiconductors. And, you know, it does, you know, allocation strategy, it will just have so many different kind of tangents and byproducts of effects and how that will affect everything you're doing. So I think just having a core, a few sentences, doesn't have to be a paragraph, that just, what you want to achieve and how you want to achieve it, just helps you stay on the straight and narrow.
So in terms of your own portfolio, it's split into an active portfolio and then a passive portfolio. And you say that you're then starting another portfolio for small caps too.
Yeah.
Is there any particular reason why these will all be kept separate? Is that just to make them easy to track? And when you're viewing your portfolio, do you look at the overall picture or do you just analyze them separately, if that makes sense?
Yeah. So again, it's like a personal preference, but it's really from, having a clearer mind space. So I have a core portfolio, which is probably 85% of all the capital that I have invested. And that's split across 15 different names. And that's where I spend a lot of time trying to, generate a performance that's going to beat the benchmark over a long period of time. If I underperform in a year, that's fine. But as long as I overperform over the lifetime of the portfolio, that's what I'm really trying to achieve. So that's the goal there. And it has that goal. And then with a passive portfolio, that's not really the goal. The goal there is to either match or slightly beat the market on a risk-adjusted basis and then earn yield as well. And the passive portfolio is really just a bunch of indexes across different areas of the world and different kind of sizes of companies. And each position has a yield. And in theory, every quarter I'm going to be getting that yield as cash and reinvesting it back into the portfolio. So it's kind of automated in that sense. The research takes up a lot less of my time, and it's tax shielded as well, which you might say you should do that in your core portfolio, as the realized gains would be a lot bigger there. And that is something I have considered. But basically, having the passive portfolio is kind of, the sleep easy portfolio. It's just there. And it's just going to compound over time, provided that I allocate it properly and continue putting money into it. But every month I'll just infuse the same amount of cash into that, spread it across the areas that I want to invest in. And the goal there is really just kind of capital preservation and compounding through yield. So I like to keep those separate because I don't want to hold ETFs in my core portfolio because it doesn't really align with what I want to achieve from that bundling of assets. And a small cap portfolio that I have, which is very minimal in terms of the overall kind of allocation, it's kind of younger as well. I have different goals for that than the core portfolio and the passive portfolio. So the goal there is really just to kind of find small cap companies, mostly in Asia, actually, with a big focus on Japan. And the goal there is really just to kind of find underappreciated small caps or ones that I think could have potential international expansion efforts going on. I only hold a few names in there. I'm still kind of building that one up. But the reason I have it separate is because I want the focus to be on small caps. When I'm in that space where I'm researching for that portfolio, I want the focus to be there. And I don't want to, a small cap could get hammered by 50%, with no news. Could just be liquidity if it's low liquidity, and this insider selling or some institution selling. I don't really want that to be a part of the core portfolio. And I think separating them for me personally just helps me keep a clearer headspace.
So when you say passives, tax shielded, and the active isn't, you're talking about inside and outside of ISA?
Yeah, so my passive portfolio is just through Vanguard and it's an ISA, and the goal is just to max it out every year, and then pretty much like an independent retirement account, if you want to call it that. Something that I'm just going to contribute to for the rest of my life, and then hopefully by the time I'm in my 40s or 50s, it will be at some point where I can stop funneling the yield back into it and take some of that out and spend it or live from it or wherever we go from there. But it's basically kind of a lifelong passive portfolio that I'm just going to keep building forever, I think.
So you cluster your active portfolio into early growth, young growth, maturing growth, and mature. Can you talk about each of these stages, how you think about allocating to each one, and also why you chose this method of measurement?
Yeah, so this is really just a unit of measurement for me to understand kind of what stages of the economic growth cycle, or the business life cycle, I should say, each of the companies that hold are in. So there's loads of different iterations of that. I chose the one that Aswath Damodaran kind of introduced, and that focuses on, early growth, young growth, maturing, and then mature declining. So there's 5 stages, and I don't really want to hold anything that is mature/declining, so I don't include that. It's just basically the business life cycle just goes through these stages, and at different points you can expect the revenue growth and the earnings stability to kind of fluctuate. So when you have something in the young growth category, it's probably a new market entrant, either in an existing market, or it might be creating blue ocean space and creating a new market and pioneering it. Either way, the revenue growth is probably substantially quite high, and the adoption is probably quite low. Pricing power is usually quite high if it's like they're creating a brand new market. The competitiveness will be low as well. Or if they're entering an existing market, there'll be a lot of competition, and the revenue growth will probably be pretty high because they're coming from a small base. But at this point, the earnings are probably going to be negligible. They won't have any. They might even be expanding losses. And as you move into the young growth, adoption kind of picks up. The brand of the company become a bit more well-known. Revenue is still growing. Double digit is still, maybe not accelerating quite to the same extent, but still growing, higher than the kind of market average. Might still be losses there if they're still continuing to grow. And then when you kind of get into maturing growth, which is my favorite kind of area, this is when the company's in a market that is maybe not quite saturated yet, but it's quite close to being fully realized. There are established industry players. The revenue growth slows down, maybe to mid in the tens region, or even single digits. But at this point, this is when you usually see the inflection between the earnings losses and the earnings growth. So the company's already established its position. It doesn't need to invest as heavily into growth as it used to when it was a younger company. And at this point, the amount that they're spending is going to be beneficial towards their kind of bottom line, and earnings might begin to pull up. They might start having margin expansion. On the operating side, and even on the growth side, is they benefit from economies of scale. I tend to look at the operating margin all the time instead of net income margin, purely just because the net income margin can be manipulated and adjusted, for non-recurring items so often. I don't think it's that great of a gauge to kind of assess the health of the company. So in the maturing stage, I would say something like Facebook or PayPal, where they don't necessarily have to be a bigger player, but as a company, their life cycle, they're kind of, they're getting on a bit. So PayPal, for instance, is an interesting one because they do actually grow pretty high, anywhere from 15 to 30% a year. And over the next 5 years, they're expected to be growing at a CAGR of 20% on their revenue, which is pretty attractive for a company that's maybe 250 billion in market cap. But they're in an established space. There's established players. There's rules. There's dynamics there. There's disruptors, but they're also earning very attractive free cash flows. They have margin expansion. They're known worldwide, but they're still growing. But they're mature. And then in the mature stage, this is where market saturation is apparent, and there's really not too much in terms of growth vectors available for the company. They'll probably just be growing at the rate that the country or the economy is growing at, maybe anywhere from 0 to 5% a year, depending on what country it's in. It depends on what kind of you're looking for, but usually at this point between the maturing growth and the mature stage, they might start paying a dividend or getting aggressive with buybacks to give that kind of value to the shareholder that they can no longer give in terms of share price appreciation because they're no longer growing at such an elevated rate. And there's definitely kind of incentives to buy a mature company if you're looking for kind of capital preservation or you're looking for yield. And then maturing decline is when you've went past saturation and the industry is actually declining. So maybe if you can use an example like newspapers, tangible newspapers, that industry began melting and declining, many years ago. I don't personally want to hold anything in that kind of situation. I don't feel like I have the technical chops to understand, buying melting ice cubes. There's definitely value in there though for some people, but that's not really my style. But I prefer just to kind of split them across those 4 categories just to give me a visual representation of where each of my companies are in the product, in the business life cycle. And typically I'll have more weight towards the maturing growth and second most weight towards the young growth, and then I'll split the rest between kind of young and mature.
You say that you adhere to strict selling rules and only consider selling a position once certain sell rules have been met. Would you be able to just expand on what some of these rules are and what could lead you to sell a position?
Yeah, so I think, like I said, with the investing policy statement or your mission statement, I think it's important that before you kind of jump into selling something, you should understand why you want to sell something so that you avoid, selling based on some kind of emotional factor, some news headline, something like that. You just avoid those kind of rash decisions. So I have a few sell rules I try to abide by. And if it doesn't meet any of those sell rules, I really have to question that. When I was talking to someone a few years ago who's on Twitter, who's a great mind, I was basically discussing my kind of lack of enthusiasm for PayPal as a company. And then he just interrogated me and said, well, why do you want to sell it? Is it slowing down? I was saying, no. Do you think it's facing like significant competition? I said, no, I think it's still, it does have competition, but I think it's still going to be, fighting for its space and continue to grow market share. And he just listed off a bunch of questions. And then at the end, he said, well, why do you want to sell it then? And that kind of made me think, yeah, you know what, you're right. I'm just maybe bored of the position, or subconsciously bored that it's not moved much. And this was when it was trading for about $20, and I'm glad that I didn't sell. And that just kind of made me realize the importance of having a sell schedule or just a bunch of allowances for sales in your process so that you avoid making rash decisions like that. So I would say there's a few, and I'd say one, which is ideally the least likely. If you need the capital for something else, whether that be in your life, a big expense, or you're getting married, or something unfortunate's happened where you need additional capital that you don't have in your personal life, you could sell a position and reap the proceeds and use it for whatever you need to. Ideally, you wouldn't have to do that because I personally don't invest any money or capital that I need in my personal life. I like to stay pretty liquid outside of my investments so that I can always avoid those situations. And thankfully, that's not happened thus far, but it's definitely an allowance for sale. If the position size has exceeded predefined limits, so my hard rule is 25% weighting, which I don't really like to exceed. And if it does, I would consider trimming. So say if Facebook went on a monster rip and became 30% of my portfolio, I would probably trim it at that point, but it's going to be contextual based. Really, if I was to trim it. But ideally, that is kind of trigger in my mind that would say you should go and assess the situation and see if you should be reducing your exposure to that one position. So if the position has went past predefined limits, weighting limits, then I would consider selling, but more likely trimming. If the original thesis is broken, or at least damaged to an extent that you feel is no longer kind of in line with why you originally invested, then you can sell. So the most recent occurrence of this for me is I invested in Livongo Health a while ago, and they then announced a merger with Teladoc Health, which I didn't really want. I liked the idea of the merger, but I didn't really want to hold the merged company. I expect the company to do very well, and it wasn't any emotion in that. It was just I invested in Livongo purely because they were growing so fast and they looked to be capturing this little niche segment of the kind of the health space. And when they got consumed by Teladoc, they were now inside a different company, and they were in different vectors of the health space, and that's not why I invested in them. So I sold. And although I did make a good return on that, I would have sold even if it was a loss-making position. Part of the emotional thing, you shouldn't look at the return before you sell something if you've already decided you're going to sell it. If there's indication of accounting fraud or compelling evidence that the financials are not really as they appear, if there's a lot of channel stuffing, if there's significant red flags, if there's weird management behavior there, I would definitely sell. Boohoo, kind of fashion retailer in the UK, was a company that I held, should I say, past tense, listed on the AIM, which is kind of the smaller cap exchange in the UK. I held them for a while, but then they had a lot of kind of issues with supply chains, and there was a lot of accusations thrown. Their auditor changed, which is never a good sign. And I sold my position for a small gain. And then might have some people say, well, you're just kind of being paper hands and selling your position based on news headlines. But for me, it was slightly different because there are serious implications there. If there's accounting fraud or anything going on in the company, I want to reduce my exposure to that and just own companies that don't have any kind of red flags of that significant going on. I would happily buy back into Boohoo, and that is something that I am considering, still on my watch list, because they appear to have kind of remedied all those concerns that I had previously. And from selling it, I missed, I think, a 25% slice of downside that came a few days later. It didn't seem like the market actually priced in the fact that the auditor changed. I think it was on a Thursday, and then only by the Monday it tanked about 20-25% over the space of 2 days. So at the time that felt good that I sold, and now it's about back up to where it was when I sold it, or maybe a little bit higher. But that's just how it goes. So there's potential of kind of any mishaps there. And I think I said management behavior, if there's weird management rotation or there's 3 CEOs in the space of a year, that's a definite red flag. Or if there's any significant key men or women that leave the company and they either provide quite a provocative response or they don't really provide any flavor of why they left, that's a red flag. If you have an overwhelming opportunity elsewhere, I think that could warrant the kind of, you're allowed to sell a position at that point. If you feel that you need the capital, you don't have outside capital, and you just want to take capital from inside your portfolio and invest it elsewhere, that's fair game. Or simply, if you've lost interest in following the company, which might sound like a cop-out, but it's true. I prefer being passionate about the companies that I'm following. And if I find that I'm not really incentivized to keep up with the quarterly reports, then I'm not doing my job. So I'll happily sell the position. I think that's my core rules for selling. Yeah, off the top of my head, I think that's the nuts and bolts of it.
Okay. You say that one of your objectives is to invest in only what you consider to be your best ideas. Can you expand on that a bit? Because I think it's a lot harder than it sounds, because you'll obviously you'll look at quite a lot of companies, and you must come across quite a lot of good companies that aren't necessarily the best companies, if that makes sense.
Yeah. Okay. I think it's kind of, it relates to me as a person. What are my best ideas? Not what are the best ideas in the market at the time. It's based on what I've researched and the amount of time that I have to do that. So I prefer to just have my exposure weighted towards companies that I've researched and fully understand, to the level where I feel like they are a good idea, or the best ideas that I have for the amount of work that I've done and the amount of companies that I've covered. So mostly I prefer that to be long term, but sometimes it could be short term. Like the MGM results example, there was a defined entry and a defined exit point. I overstayed my welcome a bit and a few, notches more in terms of returns, but there was always a defined exit point there. Even though I think they will continue to do well with the gaming unit, BetMGM and stuff like that, that wasn't part of the original thesis, and it wasn't going to be a huge part of the thesis going forward. So I sold that. But at the time, that was one of my best ideas. As I said, the margin of safety I felt comfortable with, the valuation that was being afforded in the market was significantly lower than what I thought it was actually worth. So I thought, I've done the research here. I think it's worth a lot more over the next 5 years. I think, it's going to be back up to where it was. And even after that, that'd be 100% gain, split over 5 years. In this market, 100% return over 5 years in a position might sound weak because people are earning that in the space of, 6 months. But, in the long term, that's a great return for a position. So really, I just want to have my best ideas. I know that might contradict this kind of philosophy that I have, that I might take a small starter position in something when I'm first researching it. So like something like Redfin right now, I've not finished everything, but from the initial kind of scouring of the competitors and Redfin as a whole and the management team, I like what I saw. So I took a tiny little position. So technically that's not my best idea, but I still have exposure to it. But really, I would say the lower, or the smaller weightings, at the bottom kind of rotate quite a lot in my portfolio, which is something I'm actively seeking to maybe stop. The big positions don't really change. I'll just add to them. I don't really trim them, but they stay up there and they're kind of weighted heavier. But then, the bottom, maybe 5 positions that collectively make up about maybe 8 to 10% of the portfolio, there's a bit more churn there, which doesn't really move the needle in terms of overall, returns because of their weighting. But, it's not ideal to be kind of moving around. But I'm happy with that. If I buy 1% into Redfin and it turns out maybe it's not my best idea, I'll happily sell it and move on. And I know that's probably not the most efficient way of doing it, like I said, but it works for me. But yeah, I think on the whole, just you want to be invested in your best ideas. If you have a company that you're a bit unsure about, or you don't really have any conviction in, quote unquote, then why are you holding it?
You use the Sharpe ratio to measure your risk. Can you talk about what this is and why you think it's useful?
Yeah. So basically, if you're just looking at your return, your market return versus, say, like the S&P, if you beat it by 5%, or if you beat someone else by 5%, that's great. But there are more ways to kind of view the quality of your returns over a period of time. So I think in my annual kind of overview of the previous year, I was noting that my Sharpe ratio was 1, and the previous year it was 2, and I had a superior return there. So the risk-adjusted return was actually better in 2019 than it was in 2020. So performance really has 2 objectives, and they are risk and return. And most people just kind of focus on the return aspect. So if you compare just one element of your portfolio in the market, there's not enough context. For some people, some people don't really care, and that's fine. Most people just simply compare the returns to that of the market and then, move on. A 10% return at the end of the day is a 10% return, ex post, regardless of how much risk you took, it's still 10%. Most people, just kind of fixate on that. But, as investors, we require kind of a compensation for taking higher risk. So if you're taking a higher risk, you should be earning a greater return, as it would go. So if you're earning 10% with a Sharpe ratio of 1 and someone else earned 10% with a Sharpe ratio of 2, then they've earned the same return by taking less risk. And I know in hindsight, you might think, well, who cares? They earn the same return. But it's really just kind of an observational tool to allow you to see how you've performed relative to someone else. So if you're taking more risk, you would be expecting higher return as it goes. So the Sharpe ratio is actually appealing in that it can be justified on a theoretical before the fact basis and also an after the fact basis. Like here, we would be talking about hindsight, so before the fact. So the values can be calculated using market information that's readily available, and it can be easily interpreted because it's basically just an efficiency ratio, where 1 is considered good, 2 is considered stellar, and anything above that is considered, insane. And if you're below 1, it's considered, quite poor. And the Sharpe ratio itself, if we're talking about kind of ex post, so in the past using data that's already kind of been put into place and it's already happened and taken place, we're not kind of projecting anything. We're basically just having the mean return. So let's say we have a portfolio. We'll take the mean return, the average return over the period, say it's a year, and then you kind of take away from that the mean risk-free rate over the same period. And the risk-free rate is just kind of the return that an investor can earn on a risk-free asset over a given period of time. You could use the 10-year treasury as your kind of benchmark if you want. And then you take the mean return, you take away the risk-free rate, and you divide that by the standard deviation or the risk taken over the period of time. And then that gets you your Sharpe ratio. And the greater the Sharpe ratio, the greater the risk-adjusted return is. So as I said, 1 is considered to be okay. Anything over 1 is good. And then anything over 2 is like pretty spectacular.
You say that you acknowledge that true diversity is not the simple act of holding more securities. It is, in fact, an effort to diversify risk or the standard deviation of the portfolio. So this is something that me and John have talked about quite a bit in terms of trying to generate good returns, but by holding different classes of assets. So you do it with reduced volatility, hopefully, because you try and find different assets that aren't correlated to each other.
Yeah.
With that in mind, what are your thoughts on commodities, and why don't they? Is there a reason that they don't feature in your portfolio? And in addition, how would you consider Bitcoin as part of the portfolio? And would you view it as being like a digital gold? And would you place it in the same view as you'd view like investing in commodities, or would you view it as this different, I don't know, speculative asset, for example?
Firstly, I would say Bitcoin is entirely on its own, different to commodities, in my opinion. There is that aspect of the kind of the technical factors and the supply and demand and the liquidity, all that kind of stuff. But in all honesty, commodities, I don't invest in commodities because it's purely just not something that I'm super knowledgeable about. My expertise isn't there. So, as much as I understand the need for kind of lowering the standard deviation through having different correlation of assets in your portfolio, my goal in the core portfolio is not really to diversify across asset classes. It's just an equity-based portfolio, which I'm happy with. And Bitcoin as well, I have owned Bitcoin at various points through the years, but I would never say that I was informed at all. It was really just kind of experimenting and speculation. And as much as I like the premise of Bitcoin and crypto, I'm not bearish. I'm not really bullish. I'm just kind of neutral and just, happy to be an observer in that space. But I think I can definitely, just from a risk reward perspective, I don't get why you wouldn't hold maybe 1 to 3 to 5% of it in your portfolio if that's the approach you take. If you take the approach where you want to hold a small allocation to fixed income, you want to have, a majority in equities, you want to have some rights, you want to have some exposure to commodities, then I think Bitcoin has its place in there for sure. Yeah.
Would you ever consider a commodity index in the passive portfolio?
I would, yeah, but unfortunately Vanguard
okay.
Yeah, they have really limited options, and I regret really choosing Vanguard. As much as they're a great low-cost index provider, the kind of range of indexes they have is not great. So I'll probably change that at some point in the future. But yeah, I would definitely consider that, yeah.
You've got a 14.25% allocation to Facebook, but you said it's not your highest conviction position. So I think you've already covered earlier in the interview the reasons why you've got the allocation you've got towards it. But which stock is your highest conviction position, would you say, and why isn't that reflected in its weighting if it isn't Facebook?
Yeah. Just to answer the first part of the question again, for listeners, I think conviction as a whole is not something I really adhere to. I think if you have high conviction in something and you tell yourself that, then you're more likely to succumb to biases. You know, if you want to take the kind of if you want to take it at meaning and someone says, do you have high conviction in Facebook? You know, in theory, yes, I do. But I don't like telling myself that, because then,
Okay.
you know, it kind of leads to whatever. So, you know, I have reasonable assumption that it's going to perform well from the point that I bought at, and it has done so far. The margin of safety for Facebook was pretty attractive, and that's why I took such a big position at, I forget, maybe 250, 260. I was buying around that area, and I'm not sure if it's something I'm going to hold forever, but I still think it has a lot of value not unlocked right there, and has a great management team and all the other kind of factors there. So that's why it's the biggest position, because I thought with the most confidence that I would be able to earn a decent return over the next, 3 to 5 years in that position, relative to maybe something that was already kind of super extended, that was already a big part of my portfolio. And the other part of the question was, which other ones are high conviction? Ideally, everything in the portfolio, maybe apart from the kind of smaller positions at the bottom there, they're just kind of still, I'm still researching them, but collectively they might take up maybe 5%, 6% of the portfolio. So it's not a huge needle mover there. But really anything that's in the top 10 is going to be my highest conviction. And as you said, that makes up probably about 60 to 75% of my portfolio at any given point in time. I think right now it's actually greater than that. Facebook's maybe about 13.5. Twitter is now pretty sizable after I averaged up. PayPal, Square. Yeah, I'd say anything in the top 10 really that's not below 5% allocation is my highest conviction. I don't like, I like to put the biggest weighting towards the ones that have the highest degree of confidence in. But you also then have to consider that I invested in Square when it was trading at $67, and now it's trading at maybe, I can't remember the last time I checked the price, it's above $200, and it's naturally grown in weighting without me having to add anything to it per se. So just because it's now a bigger part of the portfolio, that doesn't make me inclined to sell it. So my conviction in Square today at this price is a lot less than it is, Facebook today at this price, if you can understand that. But yeah.
Okay, a lot of your holdings are actually, I guess, what very large US companies. So, for example, Facebook, Starbucks, PayPal, Apple, Alphabet. Could you just talk about a little bit about why you like the large US companies generally, and why you think they can continue to grow going forward? Law of large numbers and all that.
Yeah, it just so happens that a lot of these companies are solid companies. They have great management teams, and they are international and expanding, and they provide a lot of value to a lot of people around the world. It just so happens that a lot of them are from the United States. PayPal are all across the world, facilitating the interaction between consumers and merchants. They're still growing, and it just so happens they're based in the US. Facebook connects over 3 billion people every month. It just so happens they're US based. I do have a bias towards the US, though. I won't deny that. That is typically where I look. But I do spend a lot of time in Japan, and then the UK is probably the third most often, the third place that I frequent the most. But yeah, I have a bias towards the US purely just because I think they have the best companies and they're global, and I like buying a company that is either global or it's expanding internationally. So Facebook is basically everywhere in the world, whereas Etsy is big in the US, and it does have a big international segment, but the international segment is still pretty young. So I like that. There's a lot of runway there.
You've got a small starter position in Redfin, which you mentioned earlier, was because you're currently researching it. But I do remember you saying on Twitter at the time you did look at Rightmove as well. So I was just wondering what your thoughts were on Rightmove and why you didn't why you preferred Redfin in the end.
Yeah, so Rightmove was very interesting. It's actually a pretty solid company with good margins, and it's the leader in the market. And I also like investing in the UK because it removes that annoying issue that most UK-based investors have when they invest in the US, which is the fee for currency conversion, and then also over time the kind of oscillation between the dollar and the pound, wherever that goes, in fact, affects your returns as well, which is a big thing to consider. So I looked at Rightmove because I was interested in the space of kind of iBuying in real estate and the real estate marketplace. So I was looking at Zillow, Redfin, Opendoor in the US, and I was also looking at some of the players, big and small in the UK, such as Rightmove and Purplebricks. And the issue with Rightmove, although I like the business, the management were okay. It just seemed a bit like a saturated market. They were already the leader. There was the international growth. They have international operations, but there's no really clear-cut plan on how they're going to bring that across the world or execute across Europe. It wasn't super obvious to me. So they're like the leader in a small marketplace in the UK where there's maybe 60, 70 million people. Then you have Redfin, who in certain parts of the business only have about 1% market share in some of them, because obviously they do a few different things, but they're at the kind of forefront of their growth period, where Rightmove are kind of teetering towards the end of it, or they're just kind of coasting, being that big player in the market space. So there's less growth there. And it's more ripe for penetration. Redfin are the ones being the disruptor, and Rightmove are the ones who are most likely to be disrupted.
What are your reasons for holding GoDaddy? And did you look at Wix at all before buying GoDaddy? And if so, what did you prefer about that to Wix?
So I actually like Wix as a company, and I was reading through the Squarespace S1 last night briefly. They're also quite exciting. There's a lot of competition in this space. So if you think about GoDaddy, so they have a few different businesses. Their largest one is the domains business, and then they also have two other businesses where it's kind of enterprise solutions and market hosting. And the marketplace hosting and website hosting, the biggest driver of revenues for them is actually the smallest TAM product. So domains, they say it's a TAM of maybe 5 billion, but they think their overall TAM for everything they do is about 180 billion. And at the time, the company were valued about 14 billion and looked very cheap relative to their peers. And it's my understanding there's a very good reason for that. They're not very nimble. They use a leverage bolt-on acquisition strategy to buy smaller companies and then kind of infuse them into the business. But everything they do is essentially the same as what these other companies do, but just slightly lower quality. I think the kind of the target market for someone who wants to use GoDaddy is slightly different to someone who wants to use Wix. GoDaddy is very simple, and it just aims at getting small business owners online as easy as possible with less friction. Sometimes you go on Wix and there's more like WordPress and Squarespace that can be quite complicated for someone that's maybe not super, doesn't have the chops to kind of build a website, or they don't want to pay someone to build a website for them. GoDaddy is very simple and cheap, and it's growing at a rate that is pretty steady. They typically grow between, the core business grows maybe 10 to 20% every year, and it oscillates around that range. The domains business is solid. I don't really see, there's a lot of people that offer domains, but GoDaddy have the largest domain portfolio there is, and that's a pretty solid business. And the other areas of the business are growing pretty quick. And the reason I invested is basically, it's an unloved company, it's in a tough marketplace, its valuation is pretty low, and it's cheap trading compared to its peers. But I personally think there might be some acceleration in their growth, either starting in 2023 and then kind of extending to 2025 and onwards. So basically, they have their kind of marketplace presence and website hosting and domains, but they're now also getting into the commerce side and the payments side through 4 of the acquisitions they made this year. And it is a small position, reflecting the conviction, because it could just be a terrible stock and a terrible company, and it could be a reason why it's trading at such a cheap valuation. I think I bought some at maybe $76. and right now it's maybe 86. But that's, you know, just the market doing its thing. That has no kind of reflection on my skills. But maybe in 2-3 years we'll see how it goes. But yeah, it's basically kind of an unloved company that maybe has a few catalysts in it, so it probably fits that, more like the MGM case that I was talking about, that kind of type of investment.
You say that you overpaid for Match, but think it'll be larger in the next 5 years. Do you think it'll outperform the S&P? And if so, why do you think you overpaid for it in that case?
I think I overpaid for it because historically it doesn't trade at such a premium. I think when I paid for it was maybe 15 times sales, and typically it's anywhere between 5 to 10 times sales. So definitely overpaid for it there. But I am willing to average down as a company that I would average down on, because I paid such a lofty premium at the start. I think if I'm adding any more at a lower valuation, it's the same company, if not better, by the time I invest in it. And there are some catalysts there that I was personally interested in. So Match Group, for anyone who doesn't know, basically just like a conglomerate of different dating apps, but they're now moving into the kind of social discovery space with a particular interest in Asia through their acquisition of Hyperconnect, which they got at a fairly good price, in my opinion, based on the projected revenues of next year and the trailing ones of this previous year. I think it's a misunderstood company, but yeah, the valuation is still pretty lofty. And the outlook for this year is supposedly going to be the same as this year, but that is based on there being no assumption of any kind of acceleration in demand towards the end of the year as economies open back up. But I think they have a pretty good wedge in the dating market. Bumble is also an interesting product, but I don't think it's a market where one winner takes all. Based on my research, people typically have between 3 to 5 different dating apps when they're, you know, looking for acquaintances on dating apps, and they typically spend, if they're spending money on one of them, they're usually spending money on 1 or 2 of them. But the thing is, you know, if you have 5 dating apps, it's probably likely that 3 of them are from Match Group. They have different kind of market niches that they serve. For the kind of 40 and over, they have the classic Match.com. They also have ones for kind of seniors, and then the kind of general population. The most popular is obviously Tinder, and then Hinge as well. Whereas you have something like Bumble, which is really just a Bumble story, and they obviously merged with Badoo, which is more European focused but lower quality engagement there. But yeah, as a company, I like it. The valuation, didn't love it, but I bought some anyway. I probably bought too much and I paid too much. So that's a lesson for me. I'd have probably liked to have bought half the position size that I initially bought, and my returns year to date would have probably thanked me for it too.
How do you feel about holding Square at its current valuation? So I think you recently tweeted saying that you felt like the value was fully realised, and it sort of got to where you were hoping it would get to in terms of valuation, but I guess without like the profitability. So like, well, what are your thoughts on that?
It's an interesting one because I actually prefer PayPal, and as a company, I like Square as a narrative and a growth story. And I just think there's a lot of bias from the US because the Cash App business, which is by far and large the fastest growing and most attractive business, with, you know, the kind of $5 acquisition cost for customers, it's great in America, but a lot of American investors don't understand that Cash App is not used in the EU and the UK because it's such a basic primitive app. It's basically a P2P, a payments to, you know, a person-to-person payments company app, sorry, that just facilitates me sending you, you know, £5 or sending someone in America $10. We don't have all of the functionality that the US-based Cash App does have. So it's very hyped, it's very expensive. It's currently, I've not looked for a while, maybe 110, 130 billion, somewhere in that range, which appears pretty excessive. But the issue is, if you don't have a predefined kind of selling rule, when you buy it and you think, I'm going to sell it when it reaches this valuation, then when it gets to a valuation that might make you feel uneasy, you're left with, you know, you have to kind of think about what you want to do. For me, I'm not going to sell it. it might be stretched. But I think it's still going to grow to be an important part of the kind of US economy in the digital banking space, along with PayPal. And yeah, it's something you have to battle with, and it's something that you as an investor really have to kind of think about. It's trading at 120 billion. If it trades at 120 billion in 3 years' time, I honestly wouldn't be surprised. And it's basically traded flat for a year, give or take. But then I invested in it in 2020, and then over 4 years, even if it trades flat from today, that's still anywhere from 200 to 300% return, which over 4 years is great. You just can't, get the returns and the volatility working the way you want to. If it's a great business, you hold it. If it's not, you can consider letting it go. So I don't think I'll be selling it, but yeah, it's undeniably trading at a lofty valuation.
Do you think PayPal's a better business? And if so, did you at any point consider selling it and just adding to the PayPal position with it?
Well, I think it's a more solid business. I don't know if I'd say a better business, but the management team at PayPal I prefer a lot more. They're far more robust. I feel like they could survive a lot more kind of disruption from external factors. And it's narrative framing, because if you look at the Cash App business, the seller ecosystem, they provide point of sale hardware to small businesses and software. But then if you actually look at PayPal, they do the same thing for their 30 plus million merchants. They provide point of sale through their acquisition of iZet, and they also provide software for them to run a business. And then if you look at the kind of Cash App wallet, where they provide investing and saving and all this kind of stuff and transferring of funds, that's great. And then if you go look at PayPal, they have two companies that do that through the PayPal app and through the Venmo app. And later this year, both of those apps are going to be transformed pretty significantly, where they're going to allow for investing across multiple assets. They're going to allow for saving, wish lists, connecting all kinds of different things into this kind of digital banking / payments / commerce experience. And that's going to be very appealing. And you have to remember that PayPal are actually a huge presence in the EU and in other areas of the world, whereas the Cash App has, it doesn't have as big a presence in the UK and the EU. So I think it's an interesting one, because I wouldn't say I favor either one, but I would probably, if I had to choose, I'd probably say PayPal, just because right now it's a more robust business and it has a clearer path to what's going to happen in the next 5 years, whereas the Square app, they're a bit more messy, maybe is how I'd put it. They just acquired Tidal, which in my opinion is a good acquisition, but there's just a lot more going on there, and the business itself is not really self-sufficient just yet. So it's a growth story, and it's a compounder story, so they're kind of different. I don't think I would be confident enough to sell Square and go all in on PayPal, because I think it could be quite likely that from my cost basis, Square outperforms PayPal over 5 years. From the current valuations, I would be more inclined to say that PayPal outperforms Square over the next maybe 5 years, but I could be proven very wrong on that, because Square's less than half the size of PayPal in terms of market cap. But I just think PayPal touches so many more consumers and merchants that it's a favorable business.
Okay, you've recently averaged up on Twitter, and you did talk about in quite some detail the last earnings release, in which they covered essentially their plans for future growth. Why do you think they're now in a position to actually deliver that growth after what must be for a shareholder quite years of disappointing returns, especially if you take the last year out?
Yep. So my thought process on Twitter was, I've been following it for a while, and then March 2020 gave me the opportunity to buy it at a good price. So I did. At that point in time, there were some early signs that the catalysts that everyone everyone longed for might actually be coming into the foray. Management had actually been speaking about commerce in the kind of earnings statements and interviews. Ned Segal, most specifically the CFO, more so than Jack. There had been discussion more frequently than there had been in the past So that kind of pricked my ears up. And at this point, like, you don't have a margin of safety there. You can't guarantee that Twitter management are actually going to roll out all these changes, because historically they've been very slow to do so. But one of the big things that they were kind of building internally was their rebuild of their map application. And once that was done, that was going to kind of allow them to be more nimble and innovate and roll products out a lot faster than they had been doing for the last 5 years. And this was just like a big hurdle they had to get over before they could really kick things off and make more promises. So that was kind of the underlying thesis for me. They were, at the time, they were the unbiasedly cheapest social media company, and for good reason. The prospects were probably the worst. And then within 2 or 3 quarters, we actually had concrete evidence that management were considering subscription products and that they were considering commerce. I remember Jack or Ned said some kind of anecdote, you're watching a basketball game and someone scores the winning basket in the last second, and you want to buy a jersey from that player. And what you do is you kind of interacting with all that commotion on Twitter, and a lot of engagement and incentive to consume is created on Twitter, but then you never actually consume on Twitter. You don't buy anything on Twitter. You go to Amazon or you go to the sports page and buy the jersey there. So he said, basically, we want to be able to, connect that final link and have the kind of propensity to consume be developed on Twitter, and then you actually can stay within the Twitter app and buy that thing, and retention. And they won't be a part of that. So at that point, that was interesting. I didn't buy any more. I only recently averaged up after their investor day. So this was all being discussed about 6 months ago. And then last quarter, when we're talking 2021 now, last quarter in February, they had an analyst day where they basically paved out their 3-year plan. And this included how they're going to get commerce on the site. It included the actual details of what subscription offerings they're going to have, the super follow button, the acquiring review, the newsletter service, and integrating that within the system. They're going to be taking fees from all this kind of stuff. They introduced Twitter Spaces, which is a great tool for kind of audio, and it just killed Clubhouse. So there's like this new layer of Twitter where, if you imagine previously you just had your timeline, now you have the timeline going through the middle. You have the exclusive timeline, which is going to be facilitated through kind of super follows and people subscribing to have exclusive content from Twitter creators, whatever it may be, and kind of oscillating between those 2 timelines. You're going to have Twitter Spaces, which is the kind of audio side of Twitter where you can just jump from reading something to jumping into a conversation in a Twitter space. And then whilst you're doing that, you can still flick through Twitter. So I think the actual engagement on the site is going to improve. The monetization per user is going to improve. The retention and the time spent on the app per user is also going to improve. And all of these new features that are now present in the platform are going to attract more new users to come in as well. So what they're actually seeing is that Twitter are projecting accelerating revenues and accelerating MDAU growth over the next 3 years. So I think I invested when the catalysts were kind of, in the distance, and I averaged up when the catalysts, someone, sparked a lighter underneath them, and now they're starting to bloom. So it's like the first purchase in March 2020, here's a small position. I need confirmation before I add anything more. I get that confirmation. I'm happy to average up, because over the next 3 to 5 years, I feel like the value that's going to be unlocked at Twitter is going to be substantial enough that will earn me a good risk-adjusted return.
You did an 80-page report on Etsy and started a position in it after doing your research for that. So as I mentioned, it's or as I said to you when I sent the questions over, it's my largest position, and I still think it's relatively cheap. How do you feel about the valuation?
So I won't say too much on the valuation because it's very subjective. And if I say it's cheap, someone will say you're an idiot. And if I say it's expensive, someone will say you're an idiot. So
is that your way of saying I'm an idiot for saying it's cheap?
No. I would tend to agree with you. I think it's been cheaper, like over the last if you were to buy it in 2016, 18, like it was obviously objectively cheaper, but I think it's still, I wouldn't say it's great value, but it's still cheap if you're really pricing out what you think it's going to become in the future. It's like buying Starbucks in 1999. It's expensive, but if you think Starbucks is going to, have thousands of stores across the US and China and whatever, and you think in X amount of years it's going to be a global force, then, over that time period it's cheap. But right now, I would say it's probably a bit pricey for right now in the current day. But then if you were to look back in 5 years, look at the price, you might be like, oh, why didn't I buy some of that? So it's really hard to tell. But typically Etsy grow maybe 15 to 30% a year. And on the top line, margins have expanded over that period of time. The business are already profitable. They already have a nice amount of free cash flow, and are still expanding pretty aggressively in the international space. But even if you just think about right now, I think the last time I checked, they were trading for maybe 15 to 17 times sales. And historically, maybe when they first IPO'd, that's maybe what they were trading at. And then they got smashed when Amazon launched Handmade, and they were trailing at about 3 to 5 times sales for a couple of years. And then from 2018 to 2019, they kind of went on a bit of a rally, and they became about 15 times sales. And then in March, they got hit. And then now they're back up at 15 to 17. So it's very volatile. And that's only really been over a space of 5 to 6 years. So right now, I think you could get them a better price, but it's hard to judge when they're ever going to be priced that way again. The only reason they've ever traded at 3 to 5 times sales in the past is because of Amazon launching Handmade, which kicked them down a fair bit. And then in March 2020, a global pandemic came, and how often did they happen? So right now, the premium probably just reflects that exceptional year they had in 2020, where they had, record new sellers and buyers, and sales increased by, over 100%, gross margin by about 110%. And right now, they have 1.7 billion in sales on a trailing basis, which analysts probably weren't projecting until maybe 2022, 2023, something like that. So if we assume right now they're trading at maybe 17 times sales, and let's say for 2021, those tailwinds from the obvious lockdowns kind of recede, and the company grows at maybe 40%, and then 30%, 20%, 15% over the next 5 years. So for this year, let's say it grows at 40%, sales would be maybe 2.4 billion, 2.5 billion. Then the following year, let's say it slows down a bit more because we don't have that Q1 tailwind from this year. Let's say it's 30%. Sales would be maybe 3.1 to 3.2 billion. Then let's say another year of 30% in 2023, we get sales of about 4 billion. And then let's say over the next 2 years, it grows 20 and 15%. So it starts decelerating here. And then by the 2025, the end of that year, we've got sales of about 5.5 billion. So at the kind of historic lows, we've got a price to sales of maybe 5 times, and the valuation is going to be about 27 to 28 billion. And that's basically what it is today. So that doesn't sound great because it's pretty flat over 5 years. But then if we're saying that the price to sales is going to be 10 times sales, then you might have something like 55 to 60 billion in market valuation, which is close to double what it is, or just slightly over double what it is today. And over a 5-year period, 100% returns, historically, that's great. And this is kind of a conservative outlook. So if you're just assuming that Etsy is going to decelerate over the next 5 years, which I don't personally think it is, then your worst case is it trades flat, and your kind of, average case is that it might be worth double what it is today. But obviously that's, hypothetical, and just ruling out every single rational bone in my body. I personally think it'll be worth more than that in 5 years. But, it really just depends how conservative your kind of outlook is. So to answer your question, yeah.
No, I think that was really valuable, especially where you're actually going through and saying, well, at this level of growth, like how does the valuation actually end up if it grows the way I think it do? I thought that was really interesting to hear. So your next deep dive coming out in a couple of weeks is Pinterest. So what are your thoughts on that business so far?
Very interesting. So I've actually looked at Pinterest before, but not really for a year or so now. But I have looked at it before when I was looking into Facebook and Twitter and Snapchat and stuff. I never ended up investing in Snapchat on a long-term basis. I've traded it before, but so I looked at Pinterest and I realized when I was looking at it this time around how little I understood it back then. I think it's very interesting, and it's not really, it gets lumped in with Twitter and Snapchat and Instagram and stuff like that, but it's really more of a discovery tool, and people don't really go there to be social. It is a social app, don't get me wrong, and there is social elements to it, but really it's about discovery. So I think Pinterest is maybe more like Google than it is Facebook or Twitter. People go on there typically to kind of be inspired. All they really need to do, in my opinion, is kind of nail down that monetization aspect where they can get people consuming on Pinterest and take their cut for that. But so far, yeah, it's very interesting, and I actually like it enough to have started a small position in it.
I also own Pinterest, by the way, and it's one that I really like. But I think for me, probably the biggest or the most important aspect of that business, I think they've got like 3 times. This is off the top of my head, so I could well be wrong. I think they've got like 3 times the number of international users as they do US users, and then the international users in the last quarter, I think revenue per user was like, I want to say about 35 cents per user, and that compares to like $6 per user for the US. So if they can just get the monetization of the international users up, then what that does to revenue, it could be huge. That's why I like it.
It could get silly. I think the comparisons, obviously the GDP per capita in the US is is pretty great, and then when you're kind of aggregating international as a collective, you're taking in like the UK where it's pretty good, and then you've got the EU where it's okay, and it's pretty bad in some places, and then all the other aspects. But yeah, for sure, I think the customer base is just so interesting, and the split between US and international. I just feel like as a company, their monetization efforts could just really accelerate that going forward if they can just nail that. And one of their focuses for 2021 is the shopping experience, which then is going to drive incentives for people to actually consume more on Pinterest. So yeah, it's an interesting one for sure. And I think it's just so different to kind of Facebook or Twitter or Instagram. At first I was worried about do I want to hold Twitter, Facebook, and Pinterest? Is that not just a ridiculous amount of exposure to the same kind of entities? But then it's really not the same in my opinion.
Yeah, well, where I actually struggle with it the most is like, how many users can they actually have? Could they have 1 billion? I've got no idea. I don't know how you'd even. That's where I struggle the most, like, because I've no idea what that number is. But then you look at the monetization of the international versus US users, and you think, well, they don't really need to grow that much if they can just monetize the users they've already got. And obviously they're not going to have zero growth. But yeah, it's one I like. So you've got a Japanese stock in your portfolio. Could you talk about how you came across this, or how it came across your radar? Is it one of the ones that was mentioned on the Japanese Substack that you subscribed to earlier? And why do you like the Japanese market? Because you said earlier in the interview that it is one of the markets you pay attention to.
Yeah, so the company I think you're referring to is Kura Sushi, and they're actually a US-based subsidiary of a Japanese company. And so I came across the parent company when I was just searching through Japanese companies, and they're called Kura Sushi. And they recently, a few years ago, opened up a subsidiary in the US where they have, I think, 30 or 31 stores now, which interested me more so than the actual parent company. And there's an interesting dynamic there because I like owning a subsidiary or a company that's owned by another company which has a significant level of liquidity. I had a similar thing when I owned the Right MGM properties, which the rent payer was MGM Resorts, who have so much liquidity they would never miss a rent payment. So that was a solid investment there. But Kura Sushi US, if you were just to take a look at them in isolation, you would think, wow, it's a pretty poorly structured company. They're using a revolving credit system for debt. Because they're a restaurant and, Corona hit them pretty hard. They don't have a lot of restaurants, but they have basically not unlimited, but they have their parent company there to tap into, which is a pretty solid relationship. If they need additional funding, they can just, they can get it from Kura Sushi Japan. And it's basically a growth story. I didn't understand how unappreciated sushi was in the US. It's quite big in the UK, but in the US, it's quite a fragmented market. There's no real dominant player, and that's what Kura Sushi is seeking to do. But quite recently, actually, I said this in my most recent report, I'm moving that position over to the kind of smaller Japanese-focused portfolio, even though it is a US-based company. It's a subsidiary of a Japanese company, so yeah. I'm putting it in that. But yeah, it's an interesting one. It's very small cap, quite low liquidity, quite volatile returns. So yeah, really just a small position just so I can monitor it and keep track and see how it goes. I'm not saying it's like Starbucks in 99, but that's kind of the kind of thing that I'm looking for. Is there going to be a company that can expand nationwide? They're already very popular in Japan. I think they have over 400 stores, locations. If they can get to that level in the US, where the population is obviously significantly larger, then that would be a great one. But just monitoring at this point in time. Okay. And you said, why do I like Japan? On so many levels, it's an interesting country. There's so many different cultural differences between the West and Japan that I find fascinating. And they have a lot of really interesting small caps, which are kind of valued, what I would say are quite undervalued or fairly valued. And some of those have interesting catalysts, which might take them out of Japan and into other areas. So I just try locate and find those companies. And I only hold a few right now. It's quite concentrated, but as I find more, I'll be diversifying across a larger number of smaller caps, just purely because they're so volatile, but just to kind of build my understanding of investing in smaller cap stocks and doing it in an isolated portfolio. So, if anything goes Pete Tong, it doesn't affect my core portfolio or anything like that. But it's an area that I want to understand a lot more, because you have greater access to the members that actually lead the company, because they're so small. You can get interviews with them, and you can, it's an interesting dynamic. It's totally different to like kind of buying into Facebook or something like that.
Yeah, you're not going to get an interview with Zuckerberg, are you?
Yeah. Can I get Mark Zuckerberg on the phone, please?
So are there any resources that you'd recommend for it if anyone was interested in trying to have a closer look at some Japanese stocks?
Yeah, I would. The way that I originally first started doing it a few years ago was I just kind of tried to find a list of the exchange, whatever exchange it was looking at, and then I literally used to just work through each company one by one and just kind of look at their IR pages and just have a brief look. It's quite challenging sometimes because the IR pages are in Japanese, so you have to use Google Translate to translate them, and then sometimes the Japanese versions of the reports that come out are maybe a week delayed because they have to translate them. So that, and also just the accounting and the reporting kind of standards and quality is a lot different from the US if you're used to that. Similar to, and the frequency and all that kind of stuff is slightly different. But the best resources, obviously, just use their IR page and just read the filings. But then there's also a great number of Japan-focused Twitter accounts out there, which are really great. Cash That Check, he's a great follow on Twitter. If you just follow him and then go down his following list, you'll find a bunch of people that are kind of Japan-focused. Also, Teddy, who I mentioned earlier, is great. And he does a lot of write-ups. And then Japanese Small Cap, which is Japan Small Cap, is also good. They do a lot of free write-ups over on Get Review. So yeah, there's a lot of options on Twitter as well. It's quite an interesting space if you follow it.
It's quite a nice compliment, actually. But you remind me a bit of Buffett there with going down the full list, because he did that in, I want to say like 2006 or something. He did that with all the South Korean stocks.
Yeah.
He picked a few. That was what he did. He literally just went down the list. I suppose it's similar to what you used to do with like the Moody's manuals as well.
Yeah, my process was like, I have no inkling, I have no insight into Japan. Like, I don't know which companies are the best, which ones are kind of perceived to be the best from the Japanese public as well. So I personally do reach out to a lot of my Japanese followers and ask for their perception and ask for contacts and stuff like that. So it's really interesting on that side. And I also like it because I don't have any preconceived biases. So if I'm looking at a company, I don't already know know what their perception is like personally. So I don't succumb to those biases, and I can just look at it very neutrally, which I actually like, and I think it helps me in my other aspects of investing as well.
Yeah. Could you explain what Celsius is? Because it's not a company I'd heard of before I looked at your portfolio. I've started seeing it pop up a bit now on Twitter, actually, but you say the valuation's ridiculous. So why is that, and why do you hold it in spite of that? And you actually recommended reading a short report for it. So can you just talk about as well, like why it's useful to actually read short reports for companies that you're long on? And
so Celsius is basically a clean energy beverage producer. They don't manufacture; they use third parties. So they have all the ingredients, and then they send those ingredients to third parties, and they manufacture them. And the whole premise is, it's clean energy, and they have these kind of internally. They paid for these kind of research reports through universities in America to kind of undertake the research, and there's non-FDA approved kind of outcomes to those, which says that they're thermogenic and they burn fat to a higher degree, which I would take with a pinch of salt. They don't have to be FDA approved to sell them, but they've never actually submitted an FDA approval, which might be a red flag, because if they're so confident, you think they would submit an FDA approval, and then if they were to get rejected, obviously that's a huge impact on them. I say they are overvalued because I think they've traded anywhere from 4 to 5.5 billion, and they have about 120 million in sales, even though they are growing, over 100% per year. So that's the kind of base. They basically just sell products related to their kind of clean energy recipes that they have in various different forms, but primarily it's through beverages. And Edwin Dorsey actually wrote that short report, who's someone I recently discovered a few months ago, and he writes over at the Bear Cave and has a fascinating story. I interviewed him quite recently, and I'll be sharing that in a few weeks. But he wrote a short report on Celsius, and I recommended it because it's just purely, you have to read what the other side of the trade is thinking. And those who take on the short side get a lot of flack, but I think they do probably the best work. So on the long side can be quite guilty if succumbing to confirmation bias, and obviously that is also true on the short side. But they're reading the proxy filings, they're trying to align incentives with what's actually going on, and just the work they do is always great detail. So I recommended that because I was talking about it, not super frequently, but I do mention it in my when I'm kind of assessing what companies I hold and stuff like that for subscribers. So I suggested reading that because this is a small cap stock, and I want people to be fully aware of the kind of the risk inherent in if they ever take a position in that. Because as much as I say don't copy what I'm doing, it's probably idea generation for some people, and I want them to be fully understanding of the other side of the trade and the risks inherent in Celsius there. And I think, just in general, reading short reports, is good if you're not squeamish. I read a short report about Peloton from Citron that said it would be valued at $5 per share. And it's interesting to see why they think that, but I wouldn't, take too much weight on it, because obviously Peloton do not trade at $5 per share.
We've got quite a way to go as well to near it.
Yeah.
Could you talk about your passive portfolio and your goals with that? Yeah. How you structure it, and what kind of strategy have you got with that? Because is it an own the world strategy, or are you just picking and choosing as you've got money to invest, what indexes actually look the cheapest? So for example, when I looked at it, there's not really any indexes that look at Asia Pacific, although you do have a Japanese one, and developed Europe as well isn't really in there. And although you've got a world index, they'll both be quite small elements of that world index.
So we've touched on this a bit already, but I think in short, it's basically just like a lifelong tax shielded yield generating portfolio, and for the most part it isn't own the world. But as I said, Vanguard's options are quite limited. They don't have any real estate based indexes, and they don't really have any commodity based indexes, which is something I would like exposure to. People say, why would you even own treasuries? I don't mind having a small 5% allocation for for that, just for the kind of standard deviation capital preservation. It's not really my goal of this portfolio to crush the index. It's really just to preserve capital and build it slowly over time, kind of like a savings account. And in a savings account in the UK, you maybe earn half of a percentage point on your money every year. So, ideally it would be beating that. Loads of sarcasm there. But yeah, the goal really is just to kind of own a piece of the world, own a bit of small cap, a bit of Japan, a bit of UK, a bit of US. The Asia Pacific, there is an index there that I have my eye on, and I probably will acquire some fairly soon. But yeah, it's an outcome of the lack of kind of vehicles that Vanguard offers at the moment.
I do think, just as an add-on, I do think it is that sort of idea you've got where you've got this separate passive portfolio. I do think it's really worth doing. So for example, with my own portfolio, I've got my actively managed portfolio. And then what I've got is my workplace pension. That's just set to automatically invest in index funds covering different parts of the world. Yeah. And the view of that is, if I'm not as clever as I think I am, which is certainly a strong possibility, the indexes, you look at how they've performed historically over decades, and as long as you're putting a sensible amount towards that, even if you're absolutely terrible at the active investing, you'll still be fine. So I do think it's worth doing. That's the end of the questions from me and John. So we've got a few listener questions. So a few of the listener questions have actually already been answered as part of mine and John's questions, but the ones that haven't been. So one of them is, please can you discuss your long-term growth views for Sea Limited?
For Sea Limited, in a few sentences, I would say the gaming, well, actually maybe not a few sentences. For anyone who doesn't know, Sea Limited is basically a similar operation to Tencent in the early days, when they have a gaming division that funds the other arms of their business. And they have a gaming division, Garena, they have a commerce division, Shopee, and then they have a kind of digital banking / payments segment called Sea Money, which is almost immaterial in size at the moment, but it is growing the fastest. And quite recently, they opened an investment arm, which they're funding with about $1 billion, as well as an AI lab, which they're recruiting for just now. So it's kind of like a five-headed or five-vectored business, but the largest two are the commerce division, which bleeds cash, and the gaming division, which has a 65% margin and actually is the cash cow of the business. And the way they fund their growth is basically through every penny of the cash cow in the gaming unit and raising equity and debt, which they love doing. The growth is all about execution. If they fail to execute, they're just going to have diluted shareholders and a big pile of debt and unproductive assets. And on the other side, if they do execute, even then they have a lofty valuation and they have a lot of competitors out there with far superior levels of capital. So it's a growth story. There's a lot of narrative baked into the price. And at this price, I don't see any value in it at all. But the business itself has great management, but their execution competency is questionable. That's what I would say.
Do you see a shift in the way we are and will be valuing old economy businesses? So, for example, mining, oil banks, also. If so, what sort of financial metrics should we be looking at?
Yeah, slightly different. I remember I was reading a book that was taking you through the history of the S&P and the kind of aggregate level of tangible assets back in the last century was close to 80-90%, and now it's closer to maybe 10-20%. So intangibles are the kind of biggest proponent to assets now on the aggregate level, and the S&P. When you think about old kind of economy companies like oil and mining and auto, there would be a lot of kind of fixed assets, heavy assets in their machinery, equipment. Now we've got Facebook that might own a few, data centers and whatnot, but a lot of their assets are intangible, and actually most of them are just current. So a lot of it's just cash and securities and short-term investments. Even Apple have about 190. I can't remember the last time I checked, and they had nearly 200 billion, I think, in cash, and maybe half of that was in longer dated debt securities, which are basically liquid because they would dilute them, dissolve them if they needed to, but they have about 100 billion in debt securities, and then the other 100 billion is mixed in cash and short-term marketable securities. All of that is just liquid. It's really like they can tap into that within a week if they really, really had to. And that's just, their balance sheet is so strong and it's so liquid, and it's basically all just current assets. So it's very different. I'm not super knowledgeable about how the market functioned back then in terms of mining and oils and banks, and which is something that I read about a lot just to kind of fill in that knowledge gap. So what metrics should we be looking at? It's hard to say. I can recognize the shift between the old to the new economy. I think everyone can, but I really don't have any kind of flavor on how we should be valuing assets. A lot of people like to say the PE ratio is silly. I don't think that's true. I think it's silly if you're using it to kind of, if you're saying, oh, this company has 500,000 PE because it has $1 in sale, whatever earnings. But like when companies are growing, they're actually purposefully suppressing their earnings and spending it all in their operating expenses. So you wouldn't really want to compare their earnings figure to anything as a valuation metric because it's artificially suppressed. You saw that with Amazon over a decade. Starbucks, I think, when it first IPO'd for about 5 years, it was trading around 90 price to earnings, which back then was considered expensive. My God. Now you have things trading at 40 times sales and people are saying it's cheap. I think it's just crazy right now. We always have to keep a level head and understand that, this isn't a paradigm shift. It's just crazy. So it's hard for me. Like I use discounted cash flow, but I don't really base my buying decisions on it. I also use it to kind of project out maybe 3 to 5 years worth of revenues and operating expenses and kind of gauge what the margin might be and what business I'm buying now, how much I'm paying for a business now, compared to what it might be in 3 to 5 years time. So you can go down that route, but there's a lot of subjectivity in there. You can use a more holistic route and just say, well, it's trading at 10 times sales and it usually trades at 5 times sales. But that's also a lot about sentiment. If someone's willing to pay $10 for a unit of revenues today, but yesterday they're willing to pay $5, well, what's changed over that period of time and why are they now more excited to such an extent that they're willing to pay double the amount per unit of sales? So it's very subjective. Yeah, I think there are different ways to value different businesses, but really, I don't really work in a lot of the spaces where I'm valuing banks and oils and auto car companies. They're probably all my worst areas of focus. So sorry, I can't be much more help there.
What are your thoughts on China and emerging markets? What place do you see for them in the markets? Do you see more or less companies being listed in the US given the continued imposition of greater requirements on Chinese companies?
Asia is very interesting on every level, just culturally, and also in terms of market perspective. China, I just don't understand, so I don't invest in it. The regime of the government, like on a humanitarian level, or whatever you want to call it, I just don't understand how the CSP works. And you see Alibaba just, a great company just getting, like taken down or just getting, smacked on the back of the hand with the communist whip, and then Ant Financial as well, getting heavily scrutinized. It's just a risk I'd rather not take. So as much as it might be promising and interesting, I just don't invest where I don't really understand. Japan, you could say Japan, like you have no idea about Japan. You've never been there. You don't understand the culture. I would like to think I do understand it a bit. I've read quite a lot about Japan, but I understand.
It's a lot closer to a Western culture as well, isn't it, compared to China?
Yeah, I mean, it's like, yeah, I would say so. Like compared to China, yeah. But there are some aspects of China where it's very materialistic and just like the US. And in Japan, you maybe have less of that. It's more of it. But, I can understand the government in Japan. The corruption there is not such an issue. Whereas in China, it's a communist regime. Like, it's just not my bag. So I'd say in general about Asia, I'm excited. But China, it's just one that I avoid through lack of knowledge.
how many hours a week did you work before you left your day job? I assume this is talking in terms of investing rather than how many hours are in your employment contract.
Yeah, I was like, full disclosure, I worked 8 hours for my employment contract. And outside of that, I was probably working, it's tough because I'd wake up at 6 and then I would do 2 hours of investment talk, and then I would work. And then even during the day, I would just be working on stuff and avoiding working my other responsibilities. So I don't know, maybe 12 hours a day on a mixture of both employment and my secondary activities, and the weekends as well, quite heavily, spending a lot of time there, maybe anywhere from 4 hours a day at the weekend. So one of the greatest things about me now starting at Castle Capital and leaving my job is that I don't have to work on weekends, and I can spend, the entire day during the week when I'm supposed to be working on the stuff that, I want to do. So it's going to be a great shift, and I'm looking forward to it.
What have you learned from your experience of starting your own company?
I think like anyone who's kind of young, so I'm 24, 25 in June, you get to a stage where you're like, you just have to kind of learn by doing stuff. Like you don't really understand how to run a company or launch a company until you do it. Nobody tells you. I didn't understand tax at all until last year. I didn't understand how to file self-assessment tax. I didn't understand the nuances of, corporate tax. I understood that, starting a company, you're separate entities. I understood the basics, but I had to learn how to file self-assessment. I had to learn all the documents to file to register a private company, and then had to find an accountant, and then had to figure out all the logistics of keeping track of everything. So I think you just have to throw yourself into doing it and learn that way. Nobody's going to hand it to you. There's no moment in time when you get given your adult status ID and you just understand how to do all these things. It's just a process of kind of muddling and doing it. I was talking with someone the other day about things that you read that, you maybe don't either understand or appreciate at the time, but they can kind of embed themselves in your subconscious. And one of those books, I think, for me was The 4-Hour Work Week with Tim Ferriss, I think. But I read that maybe when I was 19, and I hated it, and I thought it was very corny and cheesy, and I stopped reading it about 2/3 of the way through when he started talking about how to outsource your daily tasks to, I think, foreign workers for lower rates of pay and stuff like that. But what I actually realized is that the first 2/3 of the book that I read actually, stuck with me for that whole time, because I think it was from that moment on that I kind of always had this kind of goal that I wanted to work for myself. I wanted to kind of pave my own way towards doing something. I never really knew how I wanted to do that, or I wanted to just basically be in control of my own revenue streams, and I never really knew how I would do that or how it would come to fruition. But I always knew that I wanted to do it, and I think only recently I've really kind of credited that towards reading that book, or half of it, because on Christmas Eve, I think it was, maybe 2 years ago, I actually just randomly had the kind of incentive to register a private company under the name of Castle Capital, and I had no idea what it was going to be. I just liked the name, and it was kind of a mental place card to incentivize me to do something with that name, or to subconsciously drive myself towards it. So this would have been in 2019, and I had no idea. I didn't even think about writing a Substack. I didn't have a Twitter account. So I just created it, paid £12 to register it. And it was a dormant company for 2 years until earlier this year when I actually started using it. And it's the same company, although it's 2 years old. It's really only been trading for about 3 months, 4 months. So I think I'm a big believer in just, even though you might not have a kind of material understanding of what you're going to do, you should always just kind of have the optimism that you're going to get there at some point, or you'll figure something out. later down the line, it'll kind of steer you towards it. Because I think one of the best things to understand is that, opportunities come every day. And if you look, you might be looking to change career and you might be feeling down about the lack of opportunities, but, it can take a week and you might get offered 2 jobs and it could totally pivot, everything that you do in your day-to-day life. And I think having optimism that occurrences like that can take place is important, because it remains that kind of hope and that drive as well in whatever you're doing in your personal activities. And yeah, I don't think there's any harm in being an optimist. I think I'm very cynical and in a lot of things I do, but it always has that underlying optimism for the future. So I think, yeah, I know it's not really related to what starting a business is like, but I think that's just kind of some hindsight thoughts from me. Best thing to do is just to, get moving and start putting the wheels in motion, even if you're not really quite sure about what you're going to do or how you're going to do it.
Right, so that's all the questions. So, well, thank you so much for coming on the show, and your answers have just been phenomenal. And you've been you've been a pleasure to interview. It's an interviewer's dream. I just ask you a question and you just talk for 10 minutes, just giving this really clear, in-depth, succinct answer, and I can just sit back and put my feet up. So enjoyed that. So if people want to learn more about you, or if they do want to subscribe to your Substack, where can they go?
Yeah, so the main kind of platform where I communicate with everyone is over on Twitter, which is, well, my handle is @InvestmentTalk with 2 Ks on the end. And you'll find the links to my Substack in my bio there, which is just investmenttalk with 1k.substack.com. And you'll find it all on my Twitter account, but that's probably the best place to get in touch.
Thanks again for coming on the show. I think that's everything in that case, unless there's anything else that you want to add.
I'd just like to say thank you for having me on. I really appreciate the kind of format of this interview as well, like talking for 2 or 3 hours. That's the kind of interview that I like listening to.
Well, thank you for taking the time.
Yeah,
so that's half your Sunday gone.
Yeah, but yeah, thank you for taking the time as well to do it. I think it'll be good for listeners, and I really enjoyed it as well, which is good.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter @TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.